Good afternoon, everybody. We'll just begin shortly. While the panel discussion is on, request you all to please keep your phones on silent. Good afternoon, everybody. Our panel discussion is on mutual funds. You'll offer deep insights from top leaders from the mutual funds universe. I would request our panelists to please come on stage one by one. The theme would be Journey Ahead from India to Bharat. May I request Mr. A. Balasubramanian, MD and CEO, Aditya Birla Sun Life Mutual Funds, to come on stage, please. Mr. Balasubramanian. Ms. Radhika Gupta, MD and CEO, Edelweiss Mutual Fund. Request you to please come on stage. Navneet Manot, MD and CEO, HDFC Mutual Fund. Mr. Nilesh Shah, MD, Kotak Mahindra Mutual Fund. Mr. Nimesh Shah, MD and CEO, ICICI Prudential Mutual Fund. Mr. DP Singh, Deputy CEO, SBI Mutual Fund. In a conversation with them will be Business Standard Consulting Editor, Mr. Tamal Bandopadhyay. Over to you.
Good afternoon and very warm welcome. Journey ahead from India to Bharat. That's the subject, and you have seen that almost, I don't know in percentage term what exactly will be 60, 70, I don't know, percent of Indian mutual fund industry. Sitting here, this gentleman has the largest AUM, and you have taken over just right now, right? Singh Saab, from State Bank of India. Already they have already been introduced. So I'll just give the context. We have about 1 hour discussion, and we'll take a few questions. We'll not take the questions at the end. So in between, we'll take the questions like we have done yesterday. We had done. So please keep the microphone ready. Only one request is this: don't ask for any stock tips. That you can take it outside. Okay, just on at the policy level, at the macro level, etc. Now it's a very good time. I think the industry never had such a good time. I'm just reeling out certain numbers, very few. AUM 40 trillion, all-time high. Asset under management of the mutual fund industry. Just correct me if I'm wrong, any of the data. And if you look at this, typically what we said, bank deposit versus mutual fund. Bank deposit is 175 trillion and mutual fund is 40 trillion. So in percentage term, I think this is the highest ever as a percent of bank deposits, mutual fund AUM. That's one record. Second is SIP. All you know what is SIP, all the advertisements and all. Monthly flow is 13,000 crore, around 13,000 crore. Again, this is the highest ever. We have never had such a flow of SIP. Then SIP accounts, they are not unique accounts. It's not that, it's about 55 million, 5.5 million SIP accounts. But I'm repeating, they are not unique accounts. But again, it's swelling. Mutual fund portfolio, 139 million, 1.39 crore. And unique investors, if you go by their PAN number, then it's less than 40. Sorry? Yeah. 13 minutes, okay. And I said 140, 139. I said 139 million. Okay, he said 140, close to 141. Okay, 139 million, so that is 1.39 crore. And unique investors, going by the PAN, it's little less than 40 million, correct? Okay, that's the mutual fund industry. Again, as I said, it's an all-time high, it's swelling. But the other side of it, you see that the top 10 cities continue to attract 60% of the AUM. That's it. So which means we have not gone to Bharat, it's in India. And again, top 10 players, led by this gentleman, they are the 80% of AUM. So this is the industry thing. As the subject is from India to Bharat, in insurance also the same sort of discussion is that mutual fund for all, insurance for all. Similarly, mutual fund for all, particularly when everybody, including Reserve Bank of India governor, has been talking about negative real rate. So there is no incentive for the savers to keep their money because the value of money erodes because of high inflation if you keep it within the banking system. We'll come to the later, the nitty-gritty mutual fund versus banks, etc. But the subject is, and we'll start with you, Singh Saab, from there, and we'll go by this. Give just a first preliminary remarks. This. Yes, it's good time. Folio is swelling. More and more people are coming to the market and all. But still, the concentration is in India. No, this is not in Bharat. And why India? Even within Mumbai, probably the Malabar Hills and Warden Roads and Kemps Corner, there are people there. But are you going to Dharabi? Are you going to the Virar and beyond? I doubt. So how do we actually spread out? Unlike bank, you don't have any concentration risk, right? But we need to spread out. We need to, entire India and Bharat need to get the benefit of that. And need to play to your tunes in a positive sense. How do we do it? Have we started doing it? We'll get into the micro issues later. But first round, each of you, starting with Singh Saab and SBI is the largest. Your will be about 6 trillion. What's your AUM?
7 trillion plus.
7 trillion plus. So I'm dated. 7 trillion plus. You're the largest player. And then comes ICICI, then HDFC, and then Kotak and Birla. Each of you give us a sense, starting preliminary remarks.
Thank you, Tamal. First of all, thank you, Business Standard, for.
Otherwise, you change the microphone. Take the other one. Otherwise, for the sorry.
Yeah. Am I audible now? Yeah. So first of all, thank you, Business Standard, for having me here and here to discuss a very, very pertinent issue, and it's actually real. So my first response is that yes, journey has already started. The whole industry is moving towards the smaller towns, and as Tamal rightly said, whether we are going to Virar or other areas. So yes, the industry has already started going on, and technology is of a greatest help. It's not because we are not brick and mortar people. We have to penetrate into these areas by two means. One is through the distribution channel, through the intermediaries, as well as giving them the technological tools through which we can penetrate into it. And the journey has already started. We look at the numbers. The contribution by these centers is increasing day by day. The percentage has gone up, especially when we look at our own fund house. When we look at, of course, we have a unique proprietary channel which is getting money from the B30 centers. But across the industry, when we look at the numbers are increasing. And the trend has already started, and everybody is concentrating on the same. As far as technological tools are concerned, today everywhere, whether somebody is sitting on the Malabar Hills or somebody sitting in Virar or somebody sitting in northeast part of the country, everybody is having the same kind of tools available to them, and people are friendly with the technology. This is a good, very, very good opportunity for the industry. From here on, we can grow very, very well. That's my initial response to your question.
Nimesh?
I stick to only one number, 175 lakh crores, which he talked about. So I feel there is huge amount of money in the country which is waiting to beat inflation, right? 175 lakh crores. 10 years back, this industry was around 10 to 11% of the bank deposits. Today we are 22.5% of bank deposits.
That's what exactly I was telling. Huh?
This transition has been a huge transition. So when I look forward, what will happen in the next 8 to 10 years? Right, it is really exciting because this 175 lakh crores in say 8 to 10 years can become 340 or 360 lakh crores, right? If it is growing at 10% per annum. And can we be 1/3 of the banking deposits in the next 8 to 10 years? If we are there, in the next 8 to 10 years will be 120 lakh crores. 3 times of what we are today, from 40 lakh crores. So this journey, we are talking about, and it can happen because there are a lot of young people who have come. The growth, I'll just give our example and that we can extrapolate to the whole industry. This is exactly what has happened. It took us on 31st March 21, we had 5.5 million customers. The total customers that ICC Prudential had 5.5 million. In the next 1 year, we had total customers on 31st March 22, we had 7.7 million unique customers. right? What took me 23 years to build 5.5, in 1 year we were able to build 2.2 million. Where did it come from? The digital journey started, right? As soon as we made it Aadhaar based and we made it onboarding of the customer easy, right? The regulator made changes on which the onboarding became easy. This is the appetite of the market. There is not enough distribution in the country, but there are huge number of customers who want to beat inflation. If you want to beat inflation, you will have to, that 175 lakh crores, somewhere if it wants to beat inflation, it will come to this side. It has happened all around the world, so it will happen in India. And the customers are waiting. It is up to us. And I have realized that we are running risk management companies. We call ourselves asset management, but at the end of the day, when you have to manage it at scale, the scale that he talked about, 7 lakh crores, right? If that is, or we are managing around 5 lakh crores, it is all about managing money at scale. We are running risk management companies. If we manage the customer risk well, because the Indian customer's ability to take volatility, right? Whether we have not seen that kind of volatile, say a downward spiral. People have in the last 7-8 years only seen one way the market going. If you see, so I believe volatility will stay. So can we create products which are right when he says Bharat, that we have to move to Bharat, are we creating products which will balance out the volatility that the customer will face in a equity market? So that is one. And what the Indian customer wants, I think the debt mutual funds will really grow from here as the interest rates are also going. So one space that I believe can become really big and we need to manage it well is the debt space of the mutual fund. And I think that's a space where Bharat will also grow.
Thanks, Nimesh. It's a very, very interesting and frank soul searching. You yourself raised the challenges which others I would have asked you later. But thank you. Let's hear Nilesh. Preliminary remarks, and then we'll get into the micro issues.
Sure. So thank you, Business Standard, for inviting me over here. Dada, mutual fund globally is like birbal ki khichdi. It takes times to cook. We grow on word of mouth publicity, on references from the satisfied customers. Our reach is driven by happiness of our customers rather than how much commission we can pay.
All the cricketers are saying mutual fund sahi hai. Why only word of mouth?
Because they all have invested in mutual funds and they are all very happy investors of mutual fund.
Okay. That's Nilesh.
Globally, we have always seen that mutual fund is like a J-curve or a hockey stick. You work for 15, 20, 30 years to build your credibility, to build your goodwill. And then eventually word of mouth publicity takes over. And as Nimesh mentioned, in this journey, you can't afford to mismanage the risk. In the 90s, mutual fund assets were higher than what it is today as a percentage of GDP or bank deposits. But then we couldn't manage the risk well enough, and hence there was a downturn. We are a pull product, we are not a push product. I have to add value to the customer so that they can give their money to us. We are in the business of managing trust and confidence, not just money. So I have to build my trust, I have to earn my goodwill, which takes years to do, and you can lose it in one single moment. So we will make this journey from India to Bharat. We will make this journey based on happiness of our customer, based on word of mouth publicity, by reducing intermediation cost and friction cost. Today, mutual funds operate at a cost or a margin which is far lower than any other competing industry except NPS. So hopefully, as more and more satisfied customers come, our circle will keep on expanding and will continue to move from India to Bharat.
Okay, we'll get into the nitty-gritty later. Over to you, Navneet.
So the intense effort to penetrate more through the incentivization and the regulatory nudge started in 2014 with the concept of B15, which became B30 in 2018. and where have we reached in last couple of years, and also aided by the 2 basis points spent on the investor education, and you talked about it, Nilesh touched about it. That today 17% of the overall AUM is from B30, but 27% of equity AUM is from B30. You talked about that SIP AUM of 13,000 crore. More than 1/3 of it is from B30 cities. If you look at the folios, now more than 45% of the folios are from B30 cities. In fact, if you look at the growth in last 18, 20 months, and that's where I think technology has played a big part, is almost now incrementally 45 odd % of the incremental folios are getting created in B30 cities. And think about it, while these numbers are very impressive and we have a long way to go, I mean, huge amount of awareness is getting created in smaller towns. Mutual fund sahi is becoming an acceptable thing by every saver in India, but still we are only 3.7 crores. We also have to keep in mind while looking at these numbers that B30 is growing faster than the top 30 cities, but it's not that top 30 has been fully penetrated and we have no scope to grow there. So investors, even in a Padder Road or in Bandra or in Borivali or in Mulund or let's say in Chunabhatti, there are large number of those investors are yet to invest. My driver's folio gets created in Mumbai. He did his first SIP last year. And I'm sure there are many more investors. So the total 3.7 crore investors, you have like, that's the population of the 2 largest cities in India. So we have a long way to go in the penetration, both in the top 30 as well as on the B30. But I think credit to the industry, we have made intense efforts in terms of our physical reach, number of branches that have got opened up in last couple of years in the smaller town, as well as in the investment in the technology and making it easier and easier for people to understand the product and the ease of transaction so that they can be onboarded and can get taken care of. So 3 or 4 things that has helped in this penetration is, I think the first is the track record. As Nilesh rightly mentioned that it gets cooked over a period of time, right? People get belief over a period of time. Now when people can look at the track record of 25 years, how money has got multiplied 100 times in several of the funds, how they have delivered inflation beating returns, that's helping. So track record, I think, is the trust that has got built because of the intense regulation that we have. The transparency, I think, which is absolutely unparalleled relative to any other industry, not only in India, but in the world, the kind of transparency that we follow in our industry, that I think is helping. And last but not the least, I think, is the technology. I think our investment in digital, not only by us, but our ecosystem is really helping us in penetrating more. So I feel very positive of the growth, more so in B30, but I think even in T30, there is a lot more that we need to penetrate.
Your driver, you sold the policy?
I've been trying to convince for a long time, but as everybody else mentioned, and Nimesh gave you that data, I think we keep looking at this number of mutual fund AUM as percentage of the overall bank deposit AUM. But that's not the right way to look at it. The right way to look at it is the fixed income AUM of the industry as percentage of the bank deposits. It has declined in last 3-4 years, Tamal. And the bank deposits were 100 lakh crore. The fixed income plus liquid AUM in India was 10 lakh crores. The 100 lakh crore has become 175 lakh crore that you talked about. We have grown from 10 to around 13.5 lakh crores. So they still, banks deposits are growing faster than the fixed deposit AUM. Equity is a separate allocation because in the overall household balance sheet, equity allocation was 2.2% in 2014, which thanks to large mark-to-market gain plus the new money and the SIP flows put together and the EPFO money that has come, that's why it's become 4.8%.
Okay, Radhika, as all you know, that Radhika is not only handles the mutual fund, she's also an author, and her book is doing pretty well. That's what she was telling us over coffee. Anyway.
Thank you, Tamal, and thank you, Business Standard, for having me. You know, I truly believe most of us sitting on this dais are very lucky to do the job that we do. And, you know, Nimesh talked about numbers. I only focus on one number of all the numbers you said, and that is that 3.7 crore. The opportunity is massive. It is single-digit mutual fund to GDP penetration when the world average is close to 40%. I do a lot of public speaking, and, you know, as an example, I speak to a lot of armed forces professionals. And at every session I do, and they are typically people in their late 30s or 40s in well-educated parts of the country, I always ask, how many of you invest in mutual funds? And typically the answer out of 100 is never more than 20 to 30. So 60 to 70 is an opportunity. I do believe, I think there are two game changers that have happened for the industry as we move to Bharat over the last few years. One is technology. Every mobile phone today in some way is a branch. You know, I definitely represent the youngest brand on this panel. And I think for someone like us to scale up to nearly 1 lakh crores would have been impossible in an era that did not have technology and digital. So technology has made funds far more accessible, even though we are present in only 25 locations. And I think the second game changer has truly been mutual fund Sahi Hai, which doesn't perhaps get the kind of credit it does. Very few industries have all the players coming together to work for a cause and make this word Sahi Hai. Sahi Hai is now part of pop culture. You watch a Netflix show, you watch an Amazon Prime show, and people, Robert was joking about investing his money in mutual funds. We've become part of pop culture, and these are things you can't underestimate. I think there are two things in terms of opportunities that we need to think about. One is that if we have to truly penetrate B30, then thinking about making distribution more attractive. Truly penetration will happen when you have more feet on street, taking the mutual fund story to many parts of the country. And being an MFD has to be an attractive business, and you need many more, you need lakhs more MFDs out there. And Amphi is doing some work to that extent. And the second, I think, as Nimesh said, is that we've attracted a lot of investors, especially in the post-COVID phase. You need to build products and communicate in a way that retains these investors. It's very good to have investors come to the market. You need to retain them. So whether it is fixed income, where actually, in Navneet shared the data, active AUM has not grown over the last few years, whether it is hybrid funds, which don't tone down the volatility in equity, you need to make sure that the investors you have stay, because the first experience is often the defining experience.
Wala Sab, you're the last speaker.
First and foremost, it's a pride moment for MF industry. I think as everyone spoke, industry has been serving the nation. I generally call it as serving the nation, in the sense, savers' money which otherwise have been going only into the FDs. Today we can take pride, whatever the size we are talking about, 40 lakh crore size in entire mutual fund industry, 20 lakh crore size in equity. It's a large success already brought in. As each of the speakers mentioned, each passing year, acceptance of mutual fund industry has been only growing. Way of investing is becoming more easy because of technology platform changing. And then SIP is a way of investing in mutual fund also becoming the way of life today. I think there is a huge acceptance that has come, for which a lot of hard work has gone behind this. I think all of us sitting in this forum, number of man hours would have spent along with mutual fund distributors and the channel partners who have been working for the mutual fund industry. They have put lots of man hours. The benefit of this will accrue to the young speaker here.
Thank you, Bala.
Largest. So that's the way I see it. So as the India becoming more and more younger, the significant benefit of our hard work will accrue to them. It's like what we benefit out of the roads, that infrastructure that has been built in Bombay. So I'm not going to use it as much as my kids will be using it. So the same thing happening in the MF industries. So that's something I feel is a pride moment for India. Second is, each passing year, we invent something. I think B15, what Navneet mentioned about, this was part of the 2012 circular. 2012 circular, exactly 10 years back. It was visualized that we need a separate policy for investor education, which is the 2 basis points. Second was visualized, we need to take the industry beyond top 15 cities. But as it progressed quite well, as we start seeing success in the cities, in next top 15 cities, then we coined the world called B30. The B30 itself is a proof of the success that has come in those cities which is below top 15 cities, and that's where it came. Which is nothing but a step that we are being taken to increase the awareness, So that's why it has happened. So my own belief is, I think Bharat is not far off distance. I think the way I think things are moving, the way as we go down, I have traveled extensively, not in cities so much, but in the deep parts of the country. So I do have a call system, this thing called CEO Yatra, which I do it personally. The more you go on, actually look at small markets, the awareness about in mutual funds is far higher than what we think sitting in Mumbai, what the awareness exists. Second is awareness about using digital platform is far higher, especially using the banking platform is far higher in the rural cities than we are seeing actually in Mumbai kind of cities. Which in my own belief is the next round of growth for next 10 years will be significantly faster than what you have seen in the last 25 years. Therefore, the number what everybody is talking about, 120,000 crores, 1,20,000 crores kind of size, all of them will become 120,000 crores size, all of them will become very fast. The number of customers base that we have currently talking about 3.5 crores unique customers. My own belief is we will probably have a scenario next 10 years. हर घर में एक SAP होगा, हर घर में एक folio होगा. So that is where I think we are moving. Product, positioning, governance, risk, all of them actually part and parcel of the game. I think the beauty of this industry is after every accident, I mean, you may call it as an accident, you may call it as not managing risk properly. We may probably see, we also come in the attack. We being in the public domain and we become one of the, as Navneet mentioned, the most disclosed industry is mutual industry. Therefore, we are bound to come under attack. No, absolutely no issues. Because you are seeing it, easy to make for anybody to make a comment. Despite all those things, industry becoming only stronger and stronger because the practices, governance, managing risk, taking care of the investors' interests, and creating more and more awareness is actually rising, which in my view, I think will make industry to become larger and larger. And believe me, the overseas investors, when you go and speak, one of the questions is always asked by overseas investors, when would the flows in the Indian mutual fund industry will stop so that they can come and buy? That itself, in my view, is a big recognition that India has got it. The very fact that our own Honorable Prime Minister spoke about Indian mutual fund industry in the gift city itself is a big endorsement that we got it, which have never as an industry got it ever in a lifetime. So that's something I see it as a big positive, it's a proud moment to all of us. I think we have to just build on it to take it to the entire Bharat.
Thanks, Bala. So all of them are very optimistic, very ambitious, and it will go multifold. And Madam will get the benefit. Bala says that Bala meaning Bala's company is creating the field, and where Edelweiss kind of company gets the benefit. You all spoke about the challenges, the systems, processes, digitization. Nimesh picked up one. I don't know whether you remember, Nimesh. You spoke about debt. Why debt is so low. I was going through the number that out of this 3.7 crore unique investors, 90% are equity investors, only 10% into debt. So can you throw some light? I mean, it's also a part of expanding the footprint. How do you actually, I mean, why? Because mutual fund industry entices them into equity? Or what is the reason? How do we balance it out? How do we get more into debt? Starting with you, then whoever wants to talk, then we will get into some other issues. And we will take questions from you, so just get ready. Yeah.
See, after more than 20 years, whatever good has happened, we took the credit of it. So whatever has not happened also, we should take responsibility for it. I think all our products on the debt side are superior to any other competing products in the industry. On the debt side, I am now been talking only debt side. I think we need to make more effort. Just because an accident happens sometimes, because mutual funds are subject to market risk, right? And they are transparent products also. Say people sitting on the stage right now, right, have managed debt quite responsibly. And if debt is managed responsibly, because there is a equity, people are used to that there will be ups and downs, there will be volatility. Debt somewhere, we have not been able to communicate that message clearly. I believe the products are superior to any other competing products, but the customer has not accepted it till now. It is a very limited acceptance, but that's the growth area. I think the biggest mutual fund in the country, the biggest business will be the one which manages debt well, right? Because Indians want less volatility, right? So that message we'll use. We have done in the last, say, 10 years. We have sent the equity message very well. I think media has also helped that in a big way. I think we need to educate more in the market that how last 20-25 years of performance of mutual fund industry on the debt side is superior to any of the other competing products in the market. I don't think we have done as well a good job as we should have done. So that is one of the shortcomings that
Yeah.
There was a period where we tried to make an attempt. Mutual fund say, hey, is it only for equity? Mutual fund say, hey, is also for fixed income. And we had almost kept everything ready that mutual fund say, hey, fixed income be say, hey, as we equally can get convinced on the equity product. But if you look at from a saver's point of view, every savers not necessarily has to only look for wealth creations, which of course comes out of equity. Every savers also have got the income generation needs. Therefore, fixed income also becomes one of the largest component of every asset allocations, which generally doesn't get grab the attention of the investors, which I think our own belief is ultimately everything is linked to the interest rates where it prevails. Whether it is take US, high interest rates, India also has become interest rates not too high, but definitely is something which is higher than what otherwise would have got about 3-4 years back. So as it happens in equity market cycles, an opportunity even emerges on the fixed income as well. Therefore, mutual funds say, hey, is equally applicable for fixed income product as part of the overall asset allocation. I just wanted to mention that from a big picture point of view.
If I can also add, I think out of the 13.9 crore folios that you talked about, less than 6% of the folios are in debt funds, less than 6%. So 95% of the folios, 94% of the folios are only in equity funds. And as everybody else mentioned that there is tremendous potential there. The growth of fixed income funds, I think the government and policymakers must realize is very critical for the development of corporate bond market in India. That bond market will only get developed if the mutual fund industry becomes bigger, because we are the ones over the years, and Nilesh, I and Bala, we have been fixed income fund managers. We have the memories where the markets were in 90s and where the markets are today. Government of India is a large borrower, state governments are a large borrower, public sector units are a large borrowers, and corporate India over a period of time will have to borrow a large amount of money to fund the growth of the country. And for that, a very deep money market, a very deep bond market is crucial. And for that, it's important in a vehicle like mutual fund, we grow that industry. This will be good for the growth momentum of the country. I think that realization among the policymakers that we don't feel happy about the growth of equity alone, that is very, very crucial, because equity ownership of Indian household is abysmally low. How will they create wealth over a period of time? We will get into a retirement crisis otherwise at some point in time. But fixed income is also critical for a variety of other reasons.
No, that is the onus is on the industry to educate. No, you want to SEBI to step in, do something or what?
Kamal, I just
I'll
want
respond to this. Actually, you're saying we don't want SEBI to. In fact, when we are talking, we are taking credit of all good things which have been done by industry. Industry has actually failed to retailize the debt funds into the industry.
How do you do it?
Yeah, that's the question. Now we can do it, because when we talk about the debt fund, it's not only about the returns on the debt funds, but the tax efficiency also, which is huge. And we need to educate people about that. This is responsibility is with us. Now, how to do it? Till now, on the debt funds, the audience of the industry has been the wholesale investors. We have never looked at the retail investors as the audience for this thing in a big way. When we are talking about 6%, 5-6% in debt funds and 95% in equity alone, because especially in the smaller towns, there is some education, some awareness there in big towns, but in smaller towns, awareness about debt funds is not there. We have to educate the intermediaries, and we have to do the fair pricing for that. There's the acquisition cost, because we as an industry, we are not B2C, we are B2B, majorly B2B. Small portion come to B2C in direct plan, that's fine. But we need to work on that. I think we as an industry can do much more. It is our responsibility, and we will do that.
You wanted to add something?
Kamal, I wanted to add a perspective, because our growth, I mean, we have seen extraordinary growth on the fixed income side post the launch of a very different product called Bharat Bond ETF and the introduction of target maturity funds. And a lot of research was done here. I think if you look at the fixed income consumer in India, banks have actually simplified the experience for the customer a lot. There are very few decision making levers. इतने time का FD book करना है, इतना rate मिलेगा. Fixed income consumers in India do not understand very much whether it is about duration risk, whether it is about credit risk. When you make products that are simple, that meet goals. So one of the reasons something like Bharat Bond or target maturity funds have scaled up, there are 1.4 lakh crore category, almost I think larger than any fixed income category ex liquid funds in the last 3 years, because you have changed the conversation from complexity about debt to goals, plus we carry the huge advantage of taxation. So I actually believe that in this single product line, we have the opportunity to take FD customers and bring them into mutual funds in a very tax efficient way. And let me give you 2 statistics from our own experience. We launched something called Bharat Bond Fund of Funds in 2019 for individual investors, no real corporate investors. It had 300 crores of assets. Every day, individuals pour in money into that. That's 20,000 crores plus today. We hardly had long duration debt assets today. Of the 70,000 crore book we manage today, about 40,000 crores is 10-year plus fixed income investing. So people are willing to change if we simplify the consumer proposition.
So the onus is on you. I mean, you are accepting that. Any question from anybody you have? Yeah? This gentleman can... Can he have the mic? Microphone is there?
Can I?
Yeah, please. Huh?
Hi.
Just make it very brief, huh?
Yeah. I've got 2 questions. I'm a mutual fund distributor myself. Fantastic job being done by you. I've got allocation, client allocation across all the funds. And 100% of our business is digital, and it has happened in the last 2 years. So hats off to you. I have got 2 specific questions. One is respect to equity. The other is with respect to debt. In terms of equity, there is a lot of options available to overseas investors to invest in passive funds like an index or an ETF. We have seen that the options for investing in passive funds like an index fund or ETF is still at a minuscule level vis-a-vis the actively managed funds. Okay. The second is with respect to debt. That is, the moment we talk about a debt fund which is going beyond 1 year, that is, people they understand liquid fund, they understand low duration fund. But the moment we try to push it to, say, medium term or a long term, they instantly relate it to the fixed income, fixed deposit, wherein there is a certainty of getting an X amount. They don't care about the underlying risk or whatever guarantee is being given. But here in mutual fund, we can never say, itna milega, itna mil sakta hai. That is always the communication, right? So there, immediately there is a switch, and there is always a disclaimer, investment in mutual funds are subject to market risk. So here the fixed income customer, they shift to their preference to fixed deposits than a medium term, long duration, the moment it is going beyond 1 year horizon. So I've got this.
You got your point. So maybe Nilesh, you can take the first one, and anybody, Nimesh, you can take the second one quickly. Then you will get one more question from here. Yeah, quickly.
So at the end of the day, we have to deliver value to our customer. If I don't deliver value, I won't be sitting here. Now, overseas fund managers are not adding value to their investors by outperforming benchmark index. And that's where passive funds have taken off over there. Over here, most of the fund managers still end up outperforming benchmark indices. As long as we outperform benchmark indices and add value to our investors, active funds will do well. If not, then passive funds will do well.
Nimesh, on the debt issue.
See, industry has come up with products which Radhika mentioned, the target return, this one. What are the risks in a debt? You are taking credit risk and you are taking duration risk, right? Credit risk is addressed when you are only investing in Government of India securities or the state government securities, right? So in the, Radhika mentioned a very simple thing. It's very difficult to explain to the retail customer that when interest rates go down, your return will go up, etc., etc. So that is the duration risk. So when you are giving money to the Government of India or the state governments, what has happened in the past, you are taking care of the credit risk part first in the target maturity fund. Second, you know the date of 2027 fund or March 2026 fund. So there is a duration risk also not involved in that. So to that extent, and to that extent, the duration risk is also taken care of. That is why, as Radhika mentioned, those funds are really taking off. So you are giving some sort of, headlight to the customer as to what can happen in 3 years' time. And that is where the distributor also comes in, right? The distributor can understand that what is the interest rate going on for a 3-year treasury bond or 4-year treasury bond and guide the customer accordingly.
In fact, the largest target maturity funds are the longest duration ones. The largest single one is Bharat Bond 2030 at 15,000 crores.
Thanks.
In your fund.
One gentleman was looking for here, no? Or ready? Yeah, please.
Congratulations to all of you, because since 1990s I've witnessed that each of you have put in so much effort and there's been exponential growth since then in the industry. But we have seen that although wholesale growth is there in the debt funds, retail growth has not happened. And the government wants to, government and there is a thought process that the bond should be, our Indian bond should be listed in the global indices. For that to happen, the retail business has to kickstart. Do you think the retail business is not being kickstarted by the distributors as such due to the fact that debt fund brokerages are less, much less than the equity fund?
Thanks. Yeah. Abneet, you want to take this? Or
Since there is not much of a thrust to it.
I will take that, and then see, it's very simple. Wherever I go and meet mutual fund distributors, I always tell them that start doing debt first, right? If I were a mutual fund distributor, first I would want the customer puts 80% of his money in a fixed income kind of instrument, and 20% is the risk. Suppose that is the case, and which looking at the 175 lakh crores that he mentioned, my all discussions will go to that 175 lakh crore number itself. So if 175 lakh crores is in a fixed rate structure, I would only focus on that if I were a mutual fund distributor. Even if the margin is less, the volume will be more. For a mutual fund distributor, if I have got the complete wallet with me of the customer, my propensity to convert into a fixed equity instrument tomorrow will also be more, right? The banks have already shown that for a bank it is easier to convert because they have the deposits with them. Whenever they feel is the right time for the customer, they are able to convert that into equity mutual funds also very easily. So for a mutual fund distributor to do that is so important, your scale of business will completely increase. The biggest distributor in the country will be the one who will manage, who is able to distribute debt well. It's because India prominently wants that.
Thanks,
Sorry.
Ramesh. You want to add?
I want to add, in the biggest component of the banking industry, 55% is come from CASA. All of us know sitting in the room, current account, savings account balance is one of the highest on the basis of which the entire banking industry strives their growth. Let us assuming the same CASA is come to the simple liquid fund where Aditya Birla Mutual Fund, innovator of liquid fund in the country, as the first one to launch in the year 1996. Assuming scenario, somebody had put money in just in the liquid fund, the last say 25 years, would have given the least possible return of about 6.5%, which is 2% higher than the savings account. So this realization, assuming it comes to every citizen of the country, yes, I have to keep money in deposits, no problem. If I have money lying in this current account, savings account, if that means itself shifted actually to the mutual fund. I'm not even suggesting it should go to equity. That pie itself very large. I think that is where I think one has to realize what is the loss I'm incurring on not investing the money even in a liquid fund. If everybody start realizing it, that itself will give a bigger level of understanding and the growth.
Thanks, Bala. Yeah, Singh Saab, you want to add quickly?
But I absolutely agree with you, madam, that the brokerages and the intermediary cost is very, very less. In case of majority of the debt funds, we have to rationalize this. This has to be fair. Doesn't need to be equivalent to equity funds, but it could not be 5-10. That we agree, and we agree with your point. If we have to retailize, we have to make a fair pricing on this.
Okay. I think this gentleman, yeah.
When we shouldn't look at like equity and debt as purely like two different asset classes which have to be kind of participated in through two different funds. One of the good things that industry has done along with the distributors is promoting the whole concept of hybrid funds, where what you are trying to do is simplify it for the investor, where allocation is going to both equity as well as debt in the same fund. So whether it's a balanced advantage fund or hybrid equity fund or hybrid debt fund or asset allocation fund or some of the solution products, etc., or equity savings, all of these categories are targeted towards that, where investor, instead of allocating to a different fixed income and a different equity fund, is trying to do in one single fund, where idea is to get returns which are better than fixed income and volatility which is lower than equity and one single product. Having said that, notwithstanding that growth, still there is a lot more we need to do on the fixed income funds as a pure debt fund category, looking at the 175 lakh crore. And plus the insurance, where money, lot of money going into insurance actually is the money which should go into the fixed income funds.
Thanks, Ramnit. Yeah, gentlemen, quickly, very brief question. This is the last question, then we'll go back.
So when you push all mutual fund industry, when push or sell in the big towns, big cities, you compare it with the FD. When you go to the Bharat, a second category, third category of the towns and the rural area, there the surplus fund being invested, not only the FD, but there are competitive avenues are available, like gold, livestock, and farmlands. So those people will compare how much return they will get from those avenues and then the mutual fund. So only technology will help only when he decided to invest. But there is a personal repo, the personal meeting should be there with those people so that they can understand the nitty-gritty of the mutual fund working.
Thank you.
Can I take that? I think it's a very important point, because we are only looking at the fixed deposit of 175 lakh crores. 32 lakh crores is cash with public. So last year on Independence Day, we launched an ambitious investor education program called Barni Se Azadi. This is the money which is there in the kitchen jar of women to be like kind of used for a rainy day, and that money is not earning anything. And 32 lakh crore at a time where UPI has reached the level where 10 rupee can be given to a beggar, or you can buy a 30 rupee ka dhania through the UPI. Why do we need so much of cash? Why liquid funds should not be much larger than where they are today? And that's why I said, I think along with the policymakers and the entire ecosystem, all the stakeholders need to think rightly. And I think Dada, in your paper, front page ads in all the pink papers few months back, that there are 10 crore people invested in crypto. Have you done that? And we heard the governor, what he mentioned about the crypto.
Correct.
So our competition is not only with the bank deposit, but variety of other instruments. And that's where I think we all need to work together.
Thanks. So quickly, we have about 10 minutes plus 11 minutes.
Can I add
odd.
something?
Yeah, please, you add and then.
See, we are trying to change generational habit. So Volvo came out with seat belt. And because it was life-saving innovation, they didn't patent it and made it available to every car manufacturer. It was saving life. The cost was $29 at that time. And yet people were not accepting it, because we were trying to change generational habit of driving car without seat belt. People does not necessarily do what is right for them. They need to be guided, they need to be educated, they need to be taught. Gold is an investment habit for thousands of years. Fixed deposit is backed by the implicit guarantee of Government of India in bank. Mutual fund is about transparency. We are giving daily mark to market, which people are unable to understand. But we have to be like Lage Raho Munna Bhai. Keep on trying. One day we will succeed, because truth is with us.
Thank you. So you'll take you'll take the, when they are moving out off this stage, you take the questions. So we have about 7-8 minutes more than the break. Tell us one thing we are seeing of late. There are challenges, as you say, challenges in terms of products, processes, and everything, and of course, fighting it out with other asset classes. But one thing you are typically don't talk about, and let me bring that out, and I would ask maybe Nilesh to throw some light and somebody else's is the lack of talent. Of late, I just name some of the guys who have quit. Prashant Jain, Madhu Kela, Sunil Singhania, Kenneth Andrade, 4 of them, star fund managers and all. They have quit mutual fund industry. They have not quit the managing money business, but in a different AIF and PMS kind of things and all. So am I exaggerating the problem, or is there talent is an issue at this point of time when you want to take a big leap forward?
So undoubtedly, the talent is an issue. In the 90s or 2000s, when we were managing money, we didn't have to worry about alpha. We were so consistently generating it. It was like Sunil Gavaskar playing in Ranji match. He was hitting balls at will. Now our own alpha generation has come down as markets have become competitive. Now if I need to add value to my customer, I have to have the best resources. And mutual fund industry has to attract talent. Today, there are challenges on that side. Globally, we have seen that private equity and hedge fund attracted the best of the talent because they really paid those talents, and which is why many offshore fund managers on mutual fund side are underperforming benchmark index because they are not getting the right talent. They are all going to private equities and venture capital and hedge funds. In India, we have to be competitive, we'll have to attract talent, and there is obviously need for next Prashant Jain, next Madhu Kela, next Sunil Bhai in the industry. Hopefully we'll continue to attract talent because this is one industry where not only you get paid for your services, but you also get blessings from your customers if you have done well. ऐसे और दुआ दोनों मिलती है यही इंडस्ट्री में.
You don't have any plan to quit, right? No? Huh? What?
He wants to
Dada,
benefit
I
from
don't have a
Bala's work.
choice.
Okay.
I think also
Lighter wine, and a lighter one I will say, you mentioned about some of the best talent across the industry. हम लोग सब यही इंडस्ट्री में लगा हुआ है एक्चुअली. It means लगा रहते हैं अभी भी. Does it mean that we are not a good talent?
Navneet, you wanted to add?
No, I think it's the institutionalization of processes that industry has done over the last 25 years or so is something to be taken credit of. Of course, there would always be a few individuals who will always be remembered for the long service they have given to the industry. But I think at an industry, with the help of the regulators, what all of us can take credit of is a lot of institutionalization of processes. I think Nimesh mentioned very rightly, the asset management is actually a lot about risk management than money management. And I think that's where a lot of progress has been made and we have to be at it.
Radhika, you want to add? So money,
No, I would only add one thing. I think, you know,
you need to pay. Nilesh was saying that you need to pay more. Is that the right solution?
no, so I'll tell you the good and bad of it. But for all the sort of legends who are exiting the industry, which is natural, I actually think a lot of young talent wants to join the mutual fund industry, including from platforms like PMS and AIF. Now, as Nilesh said, alpha is difficult on the mutual fund platform. For every 1 rupee you earn, 0.2 rupees also goes into your own schemes. There are large amounts of disclosure. Compliance is extremely high. All of that happens. But I think the opportunity to make a public track record, when we interview, and we are a young team, largely people in the 35, 45 bracket, the opportunity to manage public money, to have a public track record. You know very few famous AIF fund managers, but everybody knows Prashant Jain, Sunil Singhania, because they have been out there and managed public money. So I think people work for a little more than money. They work for name, legacy.
You are talking like a publicity bank chairman. the pride of running the bank. Yeah, Nilesh.
I think I don't feel that's an issue because at ICICI Prudential we have learned to manufacture fund managers. Right? We have never in my mutual fund
And to
business.
manufacture fund manager.
That's what I'm saying. I'll just see India's in our mutual fund space. Right from the time that Nilesh was my CIO, we have never recruited a ready-made fund manager from outside.
Okay.
Fund management is all about building a culture over a period of time within the organization. And as Navneet said, the processes and institutionalization of processes takes place. In the last 20 years, some of our funds would have changed hands 2-3 times, but the consistency has remained. So it's ultimately, so what we have done is that you create a huge teams inside the company, let them be analysts for 10 years, going through various sectors. At the end of 10 years, if a fund manager leaves the organization, there are 10 people ready within the company to take up the fund. So it has not been missed. I don't think the mutual fund industry, look at the last 1, 2, 3 years, the performance of the funds have been good. The star fund managers have gone, but the performance of those funds have not got affected.
Okay, thanks. So I just want to have one more very interesting development what I am watching, and I would ask Singh Saab to start, and then if anybody wants to answer this and all. It came again and again during our discussion, this thing has come up, is this bank deposit versus mutual fund, and some of you said that how one needs to attract the deposits and all. As I said, 175 trillion, the pile of bank deposit versus 40 trillion mutual fund, is a percentage term is the highest ever. Now, if I look at the three large funds, SBI, largest, and then ICICI and HDFC, and then Kotak comes there. So I was going through the AUM under management versus their fixed deposit. Sorry, versus their deposits. Like in case of Kotak, it will be 55, 56%, right? In case of State Bank of India, probably 20% plus, other things and all. So tell us,
What is this 20%?
I said your because your
to deposit.
deposits about 26 trillion or something.
Yeah, okay.
And your
Yeah,
7 trillion is
20%,
this,
yeah.
so more than 20% and all. Now, what happens is, that's not only in India, even overseas also. If I'm a depositor, meaning I have a banking relationship, my banker always insists that after a certain level, till I need to keep that money to get certain priority, benefits and privileges and all. And the moment it goes up, the bank tries to push me, put the money here, put the money there, put the money there. They are not interested in keeping as deposits because they think that it's a fee income that they earn. In India too also that is the case, right? But now we have a situation in India where credit growth is 17% plus decadal high, deposit growth is not matching it, and we are staring about a gap, and people are exploring how to fill in the gap. Do you sell your excess SLR to generate liquidity? Do you go to market and use capital, etc., etc.? Now tell us, it looks like the banks which run their mutual funds, it looks like, do you divert the money to mutual fund and earn fee income, or do you keep the money with you as deposit and earn the NIM, net interest margin, by giving loan? Is it the kind of situation now Indian banking system is facing?
No, I don't think so.
I'm asking you and the other, whoever you want to do this, because this we have never seen, at least in my career, I have never seen the kind of, the deposit lagging so behind. And yesterday I was telling, I was coming back on Western Express Highway from the airport to Bandra. I found, I may have missed something, 17 billboards of different banks are asking you to give your deposits. Somebody is offering 7.5, somebody offering 8%, so on and so forth. It's something unprecedented. I have never seen that before. So at the same time, you are talking about eating into bank deposits. So how do you balance the two?
No, I don't think the kind of impression which is made that the banks are pushing their deposits into the mutual funds for earning the fee income is correct, because in banks they are making a NIM of 3 to 4%, whereas on the mutual fund they make hardly 1%. That's at the highest level. If we look at the total pie of a bank distribution, on an average it will be less than 1% only, because they are selling mutual funds and equity funds and debt funds both. Second, this impression that the bank run mutual funds, it could be Kotak, it could be SBI. Just to give you a perspective, in our business, out of 7 trillion business, only 20% comes through the banking distribution from the proprietary banking channel. It's not that 80% is coming either with B2C or from the other channels, which are equally important. Nobody can afford to have only one channel and grow this business. Today, when you look at it, the overall cost of deposit for any bank will be around 6.5%, and their total earnings are much more than that in the credit side. That is number one. Number two, when we are talking about the 9% growth in deposits, we have to also understand that out of 9%, 6 to 7% the capitalization of the interest only. Only 2 to 3% growth is happening. In case of mutual funds, if we take out the mark to market, our growth is much higher. Penetration is happening. It starts from the top going down. Our growth will be 10% plus because our industry is today 16 to 18% growth in the last 3 to 5 years. So looking at those numbers and looking at the capitalization of the mark to market, so mutual funds are definitely growing much higher than the bank deposits. That's a fact. Because the people are not very interested when you talked about the billboards. Yes, they are facing, today they are facing a lot of challenge. Deposits are not coming and credit requirement is much more. So
Yes, you are on a bank.
Can I just give one data point? The largest AMC in the world, BlackRock, was managing $10 trillion at the end of last year. The largest bank in the world doesn't even have half of that as assets. So the largest AMC is double the size of the largest bank in the world. Now look at India. The largest bank would be what, 40 lakh crores versus the largest AMC is 7. That includes EPFO money and few other things as well. So we have a long way to go in terms of penetration.
Right.
Also,
Right.
I
No,
mean,
no, just sorry, I don't interject and all. But here the difference is the largest AMC and the largest bank is the same entity.
But so for the bank, there is a choice that if you are not providing the right choice to the investor and saying that be only in
Exactly.
this product, there are 70,000 or 80,000 other MFDs, there are thousands of other RMs.
Exactly, but that's what I'm saying. Now,
I don't think that makes a
exercising
difference
this
that
choice.
largest AMC and largest bank are in the same. That this is because of so many.
Anybody
other
wants to add anything?
Well, I just add to what
Please.
Navneet just mentioned. Just look at the evaluation of mutual fund industry in the US. From where it started maybe in 1983 or 84, today the bank mutual fund industry size like BlackRock and others put together, it is much higher than the total bank deposit size in the US. That basically the more than one time of the bank deposit size in the mutual fund industry exists, which is a combination of equity, fixed income, hybrid process, money market funds as well. Assuming we have to believe and we are in the similar trajectory we are moving in, I think time will come, increasingly the acceptance of fixed income, as all of us are talking about, will keep rising. More and more investors would start choosing the other product other than FDs, which is basically you can call it the lazy investing, or maybe you are not aware about other alternatives. Today, the aware about alternatives are actually rising faster than what you would have seen maybe about 2 years back. Which is what I think will make the trajectory actually on the uptrend.
Yes, Nimesh. Essentially, what I want to know is this: when the banking system is facing this kind of mismatch, so does it make your job more difficult to get money into the mutual fund, taking away the money from banking system? That's what I want to say.
I'm just
Please.
relating to the last point you
Yeah,
said.
yeah.
The largest bank and the largest.
Yes.
I think what Singh Saab has done is great for the mutual fund industry per se. When State Bank of India mutual fund is getting in money, when SBI mutual fund is getting money, today he is getting the money, but they are able to convert customers who would have never invested into mutual funds into mutual funds. So I am very happy when State Bank of India mutual fund is growing, because when today the customer is buying State Bank of India mutual fund, tomorrow he'll buy ICICI also, HDFC also, so they are getting new customers in. So they are doing a fantastic job for the industry. That's what I feel. So it is not and ultimately the customer decides whether he wants a deposits or a mutual fund. Right? The bank is not jumping to sell them. We should go away from that. A bank is jumping towards, for a bank, a deposit is much more valuable, right, than selling a mutual fund. That's what he referred to, that the fee is not that relevant as relevant today. And with what is happening in the market next 3 years, I believe that there is going to be a huge push for liabilities for everybody. Mutual funds are also going to say sahi hai, and banks are also going to push big time their deposits.
Radhika, you wanted to have the last
I just
one.
wanted to say that, you have to give credit to DP and SPI when they launched a balanced advantage fund NFO, and a lot of us have done work in the category. The number of consumers searching for the word balanced advantage fund tripled on the internet. That finally benefits all of us. So we are all talking about India to Bharat and expanding the industry. If they can take SBI Bank's reach and help all of us, then due credit to all of them. I think we should be very happy.
Bala said, Bala and people like him created the industry, and Radhika is taking advantage of that. And now everybody syncs up. I don't think anybody who is, how old are you in this profession? 10 days? 1 month into the mutual fund industry?
Me,
Took over just?
I'm for 25 years.
No, you took over as the new position
Yeah, it's almost 6 months now.
6 months. Have you got this kind of public applause, the applause so much? Everybody
No,
is
I've,
saying,
I've got a lot of public bashing also.
Give a big hand to, to Sings Up. So I don't need to, we have already exceeded time, so let's not summarize. Everybody knows what are the challenges, everybody knows what is the way forward. I'll ask all of you to, why don't you just say sab ek saath ek baar mutual fund sahi hai. Bol dijiye ek baar mic par. That'll be a nice way to conclude. Boliye sir.
Mutual
Mutual funds.
Mutual fund sahi hai.
And one more, if tomorrow you need to create one more slogan, you said no, घर घर में ये SIP, वो भी बोल दीजिए एक बार, घर घर में SIP बोलिए.
हर घर में SIP.
चलिए. So with that note,
दादा हम कहेंगे SIP करो मस्त रहो.
Okay. SIP. Who has coined this term, mutual fund सही है? Which agency is? Which agency has? It's your term or some agency?
My time. This JWT.
JWT.
अच्छा, okay. So mutual fund सही है. Give them a big hand. Thank you.
Yeah, Bala, you should take
did
credit as MP. Yeah.
दूसरा भी है म्यूचुअल फंड फिक्स्ड इनकम भी सही है. Yeah.
Thank you all. Thank you. And we are coming back here at 2, and the subject will be equally interesting thing, gel insurance, and more or less the same is the theme. Same is the theme what we discussed here. How you take the footprints of insurance from India to Bharat. We'll see you there. Thank you.
We'll see you at 2 o'clock. Thank you for this very useful discussion on beating inflation and building wealth, not just for India and also for Bharat. Thank you very much. Thank you. And before we break for lunch, I just wanted to make an announcement. Zoho CRM, which is our technology partner, has set up a booth at the venue. You could visit the team of experts to know more about how Zoho CRM caters to the BFSI segment and offers customizable CRM solutions to companies of all sizes and types. We'll be back at 2 p.m. With a panel on general insurance. We'll do it. This is general insurance. No, we have Shankar Sharma here. No. Oh, it will be that side. Good afternoon, everybody, and welcome back. Our next panel discussion is on general insurance, and the theme is Insurance for All, the Road Ahead. I would request the panelists to please come on stage. We have with us Mr. Bhargav Dasgupta, MD and CEO, ICICI Lombard General Insurance Company. Mr. Rakesh Jain, ED and CEO, Reliance General Insurance. Mr. Ritesh Kumar, MD and CEO, HDFC Ergo. And Mr. Anup Rao, MD and CEO, Future Generali India Insurance Company. In a conversation with them will be business standards, Mr. Tamal Bandyopadhyay. Please request you to come on stage.
Good afternoon and welcome. So you can see the industry ka halat. There's a market-related thing, mutual fund, and that is full, and too many. So that's the challenge for you. That's the challenge for you. How to make insurance more interesting. How to make insurance more popular. And that's, if you see incidentally the subject also, the same thing, it's insurance for all, the road ahead, or from India to Bharat, whatever you call it. And what I was telling you is, I was pretty serious. People are more interested to listen what's happening to the market, to put their money in there, but not insurance. So what is happening, fortunately, ever since, I would say, the new regulator took over, it's basically Delhi-Hyderabad combination. Reserve Bank of India made this term very popular, VRRR, Variable Reverse Repo Rate, which is the auctions during the COVID time. After that, when they started, withdrawal of money, using that. So here in insurance is, I think, RR, regulatory reforms. That's what happening. All of you know that. Products, process, distribution, everything is undergoing a radical change. I will not talk much. People have come to listen to you. We'll take a few questions, not at the end, so keep the microphone ready. So I will start with a general comment from all of you, and then probably we'll get into some of the micro issues that we are following. Also, I mean, for the audience, I think you probably know that there's a Draft Insurance Act which DFS, Department of Financial Services, have already put on the table and for comment. So I will also ask you, what is your, how do you look at this? Because most importantly, this is talking about, if I'm not mistaken, that it's redefining insurance, if I may say so, taking the license as a media person, shorting off all jargons and all. The insurance that we know or we used to know or even know what we know, and the draft what is proposed is very different. It's completely looking at insurance from a different angle, redefining insurance. Okay, it's basically, we always talk about insurance and risk, but I think the first time, very consciously, I was going through this draft and all, it's talking about explaining why insurance is management of risk, and risk at every level, risk at every walk of life. So I will not talk on our way up, you need to talk. I would rather start with Bhargav, preliminary remarks. All the names are given alphabetically alphabet order by the surname. So Dasgupta, that's what you have been called first, and so on and so forth. So the first round, preliminary remarks about this taking insurance, ghar ghar mein, whatever. Before that, there was a mutual fund panel. We are discussing that. We started with mutual fund sahi hai, and then they said that ghar ghar mein SIP. So similarly, ghar ghar mein insurance or the R square regulatory reforms. Your first take, and then we'll get everything. Over to you, Bhargav.
Thank you, Tamal. So I have to thank or blame, whichever way you want to look at it, my parents for being in this hot seat first. Let me give a few points, and then obviously, all of us will have our thoughts on what's happening. If you look at the point that you started with, that, in terms of awareness and popularity of insurance, all behavior science talks about the fact that, people are more focused on making money rather than, giving a little bit of premium to protect an event that may or may not happen. And that's one of the reasons why insurance penetration takes more time to increase. People who actually go through an event of risk realize the true value of insurance. And as society evolves, as income increases, as families become more nuclear, people realize the need to have protection, to protect the assets that they have, or pay for large accidents that might happen to you, or an health event that might happen to you. And that's a natural journey. I mean, if you see globally, typically as per capita income crosses about $2,000 per head, the insurance penetration everywhere in the world goes up. If you look at India, the aggregate insurance market, the GI part, the non-life part, and non-life in India includes health, unlike most of the other parts of the world, the penetration is roughly about 1%, which is much lower than other BRICS countries. I'm not even comparing with the more developed countries. And if you look at insurance density, which is per capita insurance premium that we pay, it is almost 1/10 of China, which is also not anywhere near what the world average is. So that tells you about the gap that we have and the opportunity equally for the industry. If you look at any major catastrophe that happens in India, roughly 10 to 15% of the losses are covered by insurance. 85 to 90% people pay out of their pocket, or maybe at times the state steps in because they don't have insurance. So that's the unfortunate reality which we have to address. And the point that you rightly make is that I think there is for the first time after a long time, after 20 years, we are seeing a lot of initiative both from the center and from the regulator in terms of addressing this need gap, and that's, we believe, a huge positive from a longer term perspective. And I'm sure over the course of this discussion, we'll talk a bit more about some of these things.
We'll get into the micro level. You spoke about penetration, non-life is 1%. It's actually half of China, right? China is about 2%. And while what you spoke about, the density, that's the insurance premium, is 1/10 of China. So, yeah, over to you. Ritesh, just will go in this way. Just one after this and then.
Thank you. Let me try and sort of put a different twist to this. So, what I believe is that what we are presently experiencing is what I call the insurance 4.0. You had the PSUs originally to start with, and then there was insurance 2.0 when at the turn of the millennium, private sector came in. And then we had an event wherein de-tariffing happened in 2008, which was 3.0. And what we are now seeing is 4.0, wherein what we are really sort of getting into is we are trying to align ourselves to how the world sees insurance. Because a lot of things that are being spoken of, I mean, whether sort of it is in the, the act changes that are being spoken of, or the regulatory reforms that you spoke of, this is really in terms of aligning India to how insurance is practiced the world over. I mean, Bhargav spoke in terms of some of the numbers, and if you just allow me to. So, yes, I think we've got a fair distance to cover up to our neighbors, which are there. But I just want to share with some numbers.
Your neighbors meaning? I mean,
the mutual funds. Okay. the actual neighbors here.
Yes.
Okay. See, India's sort of non-life insurance penetration was 0.5 to the GDP when the private sector was allowed. At that point in time, we were the 28th largest country in the world in terms of insurance penetration. We fast forward 20 years, we've actually been able to grow at about a 16% CAGR sort of through these 20 years to come to the to come to the level of 220,000, which was the number last year, or about 260,000, that would be the number sort of by the end of this year. But we've also sort of done this journey from a 0.5 to the GDP to a 1% to a GDP. From a 28th in terms of global ranking to a 14th in terms of global ranking. Yes, I mean, and on the other side, when we look forward. So the other fact which I want to put on the table is, if we were to look at the GDP growth rate of the country, sort of through these 20 years, the nominal GDP has grown at about 12%. In a manner of speaking, our growth has been about 400 basis points over and above the nominal GDP growth rate. And what is interesting is that whether you look at the last 20 years or you look at the last 10 years or the last 5 years, I mean, on a year-on-year basis, it might differ. But as a trend, this is something which is there. And I say this because a lot of people have a view on how the economy would grow. Our industry is a little less known. And therefore, if the view is, and the larger consensus is that the nominal GDP continues to grow at a robust rate in terms of a 2-digit, the logical extension is that even without any intervention, we should be growing at that 15-16% plus. So that's something which is very, very clearly something which is there. COVID obviously has been a very, very defining sort of moment for the industry, as it has been, I think, the world over for all of us. I mean, apart from the fact that as an industry, we've gone out and paid 25,000 crores of claims, and I'm only talking in terms of the non-life industry. I think the important change that it has done is that it has made insurance somewhere from a push product to a pull product. I mean, something which Bhargav was alluding to, sort of in terms of the fact that for the first time, we actually sort of start seeing the fact that people do want insurance. And I think this is something that we need to build upon. The regulatory reforms that you spoke of are essentially sort of in the direction of then taking India to the next level, wherein, I mean, what is being spoken by the regulator is, 2047 insurance for all. So.
Yeah, Rakesh, what do you?
I think what Bhargav and Ritesh said is absolutely appropriate. Insurance, of course, is a late entrant, and general insurance in particular, obviously, is indemnity business. India has a typical mindset of savings culture, returns, and obviously, insurance in the first decade from 2000 to 2010, I would still broadly say was the decade where life insurers were establishing themselves. And we were somewhere, in a tariff kind of a backdrop. To be fair, we are a risk-oriented business. And to an extent, the first decade, we tried to discover ourselves. What do we want to do? Whether we want to open offices, people, system, processes. And, I think the first 10 years got kind of stopped with the de-tariffing. The de-tariffing was basically where the price was de-tariffed and everybody needed to now realize, okay, you're going to really price the risk. The moment the risk thing came in, people started to really build up the business model. And when business models started to evolve, you realize distribution, you realize technology, this all became contextual. To my mind, the next few years which went by, and obviously when pricing gets freed up, it invariably falls. So the first reaction is always, how do you save yourselves in that environment? But thankfully, I would say a year or two before COVID, 17, 18 onwards, the pricing had bottomed out. Most of the industry participants realized that they cannot afford going down further. Some of the companies, decided to list themselves. With a broad-based shareholding pattern, you have a new stakeholder, stepping in, obviously is looking at the financial performance of insurance companies far deeper than the traditional promoter, which IRDA, had put as a definition in the early 2000s. So I guess the ball game became more 360 degree, if you ask me. And as I see today, this COVID, if you ask me, which happened 2 years, frankly, while it's an event, it's a health event, it's a pandemic, but it has been an inflection point in the way everybody has started to think about risk, starting with consumers first. We have grown 20 years or maybe 18 years before COVID, looking at a product, motor insurance, health insurance, home insurance. This COVID made us realize that the customer is thinking about risk, so why don't we become customer-centric? So I think, there's a huge evolution. It has happened maybe in stages, but it has happened in the right way. We are today at the cusp of creating, the next 20 years in a very different way than the past. So it's a very opportune time for us. We are all lucky to be here at this point, to really see this and maybe carry some of the things forward.
Thank you, Rakesh. Anup, last word is yours, but you have to really outshout your neighbors and or whatever the friends, as you said, no? Literally, because of the logistic issues. I am told that here you can't have the walls more than 10 feet. So that's the voice coming over here. So just get into the game of outshouting. Huh?
I'm glad you clarified you're referring to those neighbors and not the neighbors here. So,
Yeah.
So,
Yeah, of course. This is an industry. No. Yeah.
So I think what everyone has said is true, but when we talk about things like penetration, etc., I suspect that's true of every category in India, be it automobiles, be it fertilizers, be it colas. You will find that opportunity in case you look at anything in terms of per capita consumption or in terms of penetration. So that's true. Also, if you speak about COVID, it's been in some sense an inflection point for everyone, not just our industry. I suspect it's been for the media as well. I mean, I don't have a physical newspaper. It's been entertainment. I've watched 2 movies on the screen since 2020, and I remember both of them. And that too because I think they were not released on Netflix. So I think the opportunity really for us is, and I just want to use a couple of examples here. One is that if you look at the brand consideration scores, there's a significant difference between different brands. So, some of the players have a very strong consideration and awareness. Are you aware of the brand? And in case you're aware, would you buy that? And that question is asked of many players. But that doesn't reflect in the purchase decision of the customer. So in case somebody's saliency is significantly high, that seems to have absolutely no bearing on the customer choosing that brand or not choosing that brand. You find the difference is not as stark. Now, what does that really tell you? That tells you that we are by and large selling a commodity still. And I think the opportunity really for us is in can we move away from selling, say, salt to selling insurance, which is differentiated. And I'm using salt as an example because I worked in the salt industry. And then it was very hard to go to somebody and say that, my salt is better than your salt because it's salt, right? I think that is the opportunity we should be looking at. And I think, speaking of regulation, some of these enabling regulations will give us appetite to try some of those things. And in that sense, move the industry forward towards making a truly consumer-led product. So that's what I wanted to add to the conversation and the discourse here.
So it's a sort of soul searching, if I may say, all of you which you have done. You are aware of the challenges and you say there are opportunities. Now we'll hear you, how do you seize the opportunities, what do you want to do? Before that, some of the stuff which has happened in the very recent past, COVID, of course, is an inflection point that all of you said. But from the regulatory point of view, the PE investment, entire thing has been liberalized. Banks distribution, which was confined to three insurance products, now it's gone to 9, right? So then the Bima Shugam platform, which is EQIC digital, etc., etc. So there have been a lot of changes. But now each of you, can you tell us about the draft act, which one of the interesting part is this, is talking about the composite way of doing things, both life and non-life. That's a very interesting aspect of the thing, and there are many more. So just presume that none of us know anything about it. So what are the things which you feel, if like we are giving a sort of feedback through business standard platform to the government, to the DFS, what acceptable, what is not acceptable, and what they missed out. So we'll start in the reverse way. Anup, you start this. Be frank. You're using the platform. You just say these are the things, lovely, it will change it. These are the things which are not acceptable, probably advisable not to be done. And these are the things which are missing out, because we have a insurance regulator now who listens to all, and it's pretty. I mean, he was supposed to be here today, but he had to fly down to Toronto for some international program. That's why he deputed one of his colleague, and he gave the first speech. Wonderful, with lot of again the focus is on from India to Bharat. Focus is on entire thing, how looking at risk management in a different way, with lot of facts and figures, but very clinical, precise. He knows extremely well what is he talking about, and this is what we have got a regulator, Mr. Panda, who knows what he is talking about. So give us your free feedback.
See, I mean, again, to provide some background, whatever has come out has happened in consultation with the industry. So I think there's largely consensus on what's been put out as draft. If you ask me, I think
just give us as two sets of things. How does it affect us, the people who are your buyers, and how does it affect the industry?
See, I think if you're talking about the industry, I think in some stage it does. I mean, I think fundamentally it does provide access to distribution to people who have been left out in the past. I think there was this discussion that earlier it was like one insurer, one bank, then 3 per bank. Now the fact that you can go up to 9, it gives access to players who may not have that privilege, and in case the banks were to exercise that. So it levels the playing field to that extent. As far as composite license are concerned, you'd asked that question, but I think, I mean, frankly, I don't know how that will work, because the way we think about a life company and a GI company is very different. And running those two under a single entity will require, I mean, could happen, may happen. I mean, a JV partner has entities in Europe which have a common life and non-life license. Could happen, but then, there's obviously, it's going to take time to put those things in place. But I think eventually use of technology, leveling the playing field, would hopefully lead to a situation wherein companies will have to outshine others, not just in terms of pricing, but in terms of the kind of offering the customer might get. And that's really my hope and my wish that really happens. And therefore, the customer gets, again, to give you another unrelated example, I was speaking to the CEO of a food aggregator a few weeks back. He told me they've seen some interesting trends that customers want customization. I asked him that, you're a food business, tujhe kya customization chahiye? He said increasingly a large number of customers, when they order from multiple restaurants, not a single one. So he says in a lot of cities, and tier 2 cities especially, people he says over 10% of the customers order from 2 or more restaurants at the same time. Now, if you look at the aggregator business, wherein we traditionally felt that somebody is making a choice of a restaurant or a cuisine, in case you see so much variance. I mean, and I asked him out of interest that, is it of the same kind of cuisine? He says, no. You could order Chinese from one and Indian from another. And that's what happens. But I think these are a couple of things which we haven't leveraged very well in terms of making something attractive to the customer. And these enabling regulations will hopefully push. See, the issue has been insurance in some sense has worked on access or capture of distribution. And frankly, your distribution share is what leads to your market share. Like I said, salience and consideration doesn't seem to impact. So hopefully some of these regulations will lead to that in terms of giving better value proposition and choices to the customer.
Thanks. Ritesh, just one point to remember is this, all of you are emphasizing on technology, but technology, you don't have any monopoly on technology. I'm just saying technology, that digitization is true for the entire financial sector. Mutual funds have that advantage, banks have the advantage, non-banking finance companies have the advantage, account aggregators and whatever it is you're calling about. So it's not it cannot be an USP For insurance companies, yes, you are banking on, everybody talks about, not only in this fora, that technology will change, but technology will change others also, changing others also. So technology cannot be an USP, technology is for all, same. It's very democratic world. Keeping that in mind, tell me how this new proposed the changes in the new act, Insurance Act, change the life of us, your customers, and change the lives of you, the industry.
To my mind, the composite license is something which is being spoken of, and it's a very, something which is very interesting. Now, if one was to look at it, this
Which
is
are the globally, can you give us a sense, what does this work, composite license?
Our joint venture partner operates in, they are based out of Germany. In Germany, you can have a composite license. They have a very large operation in Poland. Poland has composite license. Their third largest operation is Austria. Austria has composite licenses. So, composite license is something which is fairly well there. I think what is important.
Yes, please.
Sorry, just to add. Sorry, Ritesh. Even mine, generally too has composite licenses. But but then what we understand from those other markets is that it's far easier to start with a composite license than to have two companies and then merge them together. That is what gets complicated, and that's what really takes time.
Sure.
So I just wanted to add that point.
Yeah, sure.
No, so the point which I am making is that all these markets also, they would have a separate entity which is doing life and a separate entity which is doing PNC. So it's really about how you want to organize yourself. I have often said that, as a non-life company, we really run 4 companies. We run a motor company, we run a health company, we run a commercial lines company, and we run a crop company. So these are SBUs which are there. Life to that extent becomes the 5th one. So, this is really about how do you wish to go out and organize yourself. In some ways, at a lot of times, even distribution needs to be segregated, because the kind of channels that you require for motor may be very, very different from the channels that you require for health. This is something which, as a non-life entity, we ourselves experience. So I think this is really in terms of creating an enablement. There will be organizations which would sort of want to move the composite way. There would be organizations which would want to stay as individual entities. Now, at the end of the day, I think something which the regulation is also doing is, it's also talking in terms of enabling a lot of either smaller licenses to come in, captives to come in, a host of other sort of micro insurance companies to come in. They want to do away with the restriction of 100 crores on the capital. So I think at the end of the day, as I understand, there are about 18 or 19 licenses which, as we speak, are sort of with the regulator.
Yes.
So what we are really talking in terms of
pending license, you're talking about the seekers, license seekers.
License seekers. So what this means is that there would be more sort of choices available to the customer. To my mind, as an individual, I'm also a consumer. Choice is always good, and this is what we will go out and see. What it would also do is that it would also sort of ensure that whoever is already in the industry behaves more responsibly. A lot of times in a monopolistic situation, you can sometimes tend to think that because there is no choice, I can still do things my way. So this is something which is going to be beneficial. 2, composite license does not mean that everybody would go that path. 3, it will ensure, a much better market governance, sort of to my mind.
Incidentally, I'm a customer. Huh? Okay.
You are in safe hands.
Okay. Yeah. Rakesh.
So I'll add to what Anup and Ritesh said.
Is there any deadline? DFS is looking for? By when do we see the final shape, the amendment to the act and the new rules coming in? Or is it open-ended? To give the comments. Yeah.
So comments have been given. I think a lot of thinking is now, a lot of thinking now is emerging in terms of what people do. If you ask me, this is a very significant change in the way the Insurance Act was, created. When it was created, there were a lot of reminiscence of the earlier era, the public sector times. You still had a lot of, things controlling, how your businesses will shift, how your payouts will happen, how, distribution will happen. Many of these things have got lost out predominantly for two reasons. One, we have become a market-oriented economy, and two, the way we drive things is digital. And you know, most of those paper-based brick and mortar style of laws in some time really come up for change. So I think insurance had to happen in this way. The good part is IDA, appropriate to its name, of the developmental goal, has taken this as a first thing. The new chairman brought in this thing as an agenda, and I think the way he is pushing on timelines clearly gives us that ability to now really construct a business model where customer is in the middle. If you ask me, the composite today helps me to give a customer a complete solution, as against typically selling him a few products. Of course, that giving of complete solution is an optional thing for an insurance company, but if it wants to, it can really do. Many of us in the past, we have struggled. Like for example, in COVID time, there was a huge demand. People wanted to know whether you will cover death. And many of us, we were conflicted, because if it's a natural death or something which happens post-COVID, what do you do? And, you know, while you can have an accidental death covered, you know, these kind of boundaries, frankly speaking, is not something which any consumer understands in today's environment. A digital environment gives you the opportunity also to customize. 130 crore people, you know, you really don't want an off-the-shelf kind of a proposition. What kind of customizations you need? Okay, you want to give a localized product in a rural area. Now for that, if you need a certain type of an entity, the Insurance Act has to customize to give that entity in that place to give that solution. So in my view, these are like more market oriented. It gives an opportunity for people to now create the real business model they want to pursue. You want to be a boutique guy, you want to be a large guy, you want to be only a surety guy, you know, you name it. Perhaps now you can do it. This is where I think this Insurance Act intends. All the regulations surrounding it hopefully will go to, you know, give that impetus to the insurance companies as well as to the distributors to reach the real Bharat, what you were saying.
Bhargav, so you had the tough task of starting, and now you have the even tougher task because you need to talk something else and repeat.
Yeah, absolutely.
And after that, we'll take a few questions and go back. So please get your questions ready, but no, it's not a grievance cell, grievance redressal cell. So don't say that ICICI Lombard is not paying me, I filed the form so many days before, etc., etc. वो सब नहीं चलेगा. Just plain policy level questions or anything you want to know, but nothing to do with your personal thing. That you can get outside the hall when people leave. You can just follow them and ask your questions. Those questions. Yeah, over to you.
So if I can just step back, and I'll add a couple of other points. So if I can step back, I think the basic
will it lead out to a shakeout in the industry, as some people are saying, the new shape of that?
I'll come to that. But if you step back, the erstwhile act was a reminiscence of the British Raj Act, right? It's a 1934 act, and for 70 years we've not done anything about truly rectifying it. And some of my colleagues have talked about the fact that we are now finally starting to modernize the way the world is looking, considers insurance. So the first key aspect that I'm seeing in this act is that it is redefining insurance and what value insurance provides to customers. Insurance is not just a risk transfer product. Traditionally, that you understand insurance is, as the act defines insurance, it's a cover to pay. If you give me a premium, I pay for a claim. That's a kind of a risk transfer solution. What post this act and the reforms that the regulator is looking at, what will change and will address the first point that you talked about is the popularity and awareness about insurance, is that if it's insurance, if you look at insurance just as a premium and claim relationship, then the relationship is very weak. Because at the end of the day, out of 100 people that pay premium, maybe 7-8 people actually have a claim, not 100%, right? That's the insurance model. So for individual customers, the probability of experience the servicing from the customer from the insurance company is very low. Switch it to a insurance being a risk management and a risk service business, which is what globally is, it is moving to. Then you can engage with the customer, work on, in the example of, let's say, health insurance, your wellness in your health outcomes, rather than just paying for a claim when it comes to a hospitalization. If you look at the total healthcare spends in this country, roughly 30% or 35% is in the hospitals. That is all we are taking care of. 60-65%, which is outside the hospital, pure health insurance, healthcare costs, plus the entire wellness, fitness and all of that segment is out of scope for, the industry in the way it is today. Similarly, for corporates, you can actually provide a lot more value-added services which actually mitigate risk rather than pay for a claim if the risk happens. And that's tremendously more valuable both for the customers. You asked a question about the customer, tremendously more valuable for the customer and society at large. And that's the role insurance should play and will play going ahead. Second theme that I'm seeing is the entire approach to regulation was very rule-based. For the first time, we are moving to a principles-based regulation. And that's something that all of us in the industry are very, very happy to see not only the draft act, but also the initiative that the IRD is taking in shifting to a principle-based regulation. So what it will do is streamline the entire operations. Even there is tremendous amount of micro-regulation rules, very, very narrow definitions of everything in our current regime, which goes away, which doesn't add any value. It has over the years unnecessarily constrained the industry, which will open up. Again, what it does, some of my colleagues have talked about, is the fact that customer doesn't see his or her life in a narrow lens of motor or health. In the past, we couldn't bundle a product which looked at a customer's risk landscape and provide a composite product across all types of risk. We couldn't do that. It was not allowed. Today, potentially going ahead, we will be allowed to do that. And lastly, I think there is a realization, and Rakesh talked about it, that finally at the end of the day, you have to have people on the ground at the remotest location to provide access to insurance. Because insurance is not something that people wake up in the morning and say, I need to buy an insurance. You have to go and educate people, create awareness. There is a cost associated with it. You cannot assume that with a minimum amount that we are willing to pay, people will do that. The approach today is now opening up the distribution. What we've seen has happened with the bancassurance side, which is a very big positive. What really should happen is even at the individual agent level. Because if you think about it, an individual insurance agent is significantly more competent and and more aware and more knowledgeable about insurance products than a bank relationship manager. So if a bank relationship manager can sell 9 products, 9 insurance companies into 3, because 9 life, 9 non-life, and 9 health, then there's no reason why an individual insurance agent cannot sell as many. And that's what will create the real scale up in terms of distribution. Because if you limit an agent to one company, for him, he is not able to provide choice to customers. And the cost of adding more distribution, individual retail agent distribution, where everyone is tied to one insurance company, is significantly higher. So this is the way to leverage the existing distribution that we have, and I think will open up the distribution a lot. So if you have one thing that you asked me about, anything in the act that we think we should still look at is act is not very clear about opening up the retail distribution model on an open architecture model, which has been done for the corporate distribution, which should be considered if you want to achieve the scale and insurance for all that we are talking about.
That I'm sure in your feedback you have given, right? Okay. So essentially you're talking about in terms of the multiplier effect in the distribution part. Yes. This lady? Yeah. Just make it very short. Huh? No comment, only question.
Yeah.
And to whom you are asking? Quickly.
So I'll ask it to everyone.
Yeah, quickly.
Just a quick question. We talk about insurance density, we talk about penetration always. But when it comes to underwriting a case or an risk, we typically go by the books. With due respect to everybody, we go by the book, saying it is what our SOP says and we'll do only by this. So are your companies taking any initiatives on this line, saying, something like an unconventional insurance or underwriting it in an unconventional way, the financial parameters or other parameters, you relax it and figure out whether he is a good risk to take into your books.
Thanks.
Beat health, beat anything.
Thanks. Anybody want to answer?
Maybe I'll add my comments and others can add to it. Look, you cannot build a sustainable business without being disciplined from an underwriting perspective. You cannot run a business where you're consistently losing money and hope to sustain that organization and provide service to customers. If you're not making underwriting, or maintaining underwriting discipline, you will not be able to service your customers well. So that is the first principle of any business, and also true for insurance business. Your second point, which is a very relevant point, is that are we looking at new factors? And what can we do about new product categories? And let me give you 2 examples. So one, in an existing product category, let's say like motor insurance, one of the things that all of us have done in different ways. Something that we've done is launched products which pay how you drive. So if your driving behavior is good, I will give you a price discount. This wasn't possible even 1 year back with the new regulator. In the reform mindset that we are seeing, that's been allowed. So we've launched a product where not only can you buy one policy for both your cars, 2 cars, or your car and a bike, or 4 cars. So that gives you a composite, solution for all your assets, which is unique. Where you're also giving you products where we charge lower premium if your driving behavior is better than the benchmark, for example. Second example that I want to give about new categories of risk. So again, I speak for the industry. Most of us have launched cyber insurance for retail customers and corporate customers. Now this is a very risky product because it's an unknown risk even for us. All of us are learning this exposure. But still, as an industry, we've taken the lead and launched cyber insurance products because it's the need of the society at this point in time. And there are similar other examples which I'm sure my colleagues can add.
Thanks. Yeah, quickly if you can. Yeah, want to give?
I'll move to health since motor and cyber sort of was spoken of. See, as an industry, I think the first principle that Bhargav spoke of has to be the underlying. At the end of the day, if I need to grow, I need to be in a position to attract sort of for capital, and which basically means I need to sustain myself. If one is not able to sustain, then one will have to cut corners. Having said this, I think there's a lot which is also being done on the health side. And to your point, essentially the way it has to move in is you either have higher deductibles, you have sub-limited covers, you start with smaller covers. So that's something which is happening. I think something which will go a long way in this is that unfortunately on KYC, I mean, given the fact that our products were low value products, we had a very, very relaxed KYC as far as non-life was concerned. It only kicked in if, once the claim threshold crossed 1 lakh, and then it was relaxed to 50,000. Now, starting Jan 1st, with KYC getting kicked in, once we will also know our customer better. I think because once the element of fraud and some of this will sort of will come down, or we'll be able to address that, gradually some of these products also will increase. But on the health side, there are a lot of products, so to say, which have got this element.
Thanks, Ritesh. You want to add?
No, I just wanted to add, you see, when you don't have specific experiences, you generally group things. So if you really see what India, when we say 50% of the people are covered in the Pradhan Mantri, Arogya Jeevan Bima, it's basically to say, look, I can't price an individual guy in a rural area, so I might as well as give it to the entire district, entire state, and all like that. This, over a period of time, culminates towards customized products to individuals. As India will move up in the pyramid, as people will start to earn more. So I think that is the journey which we'll have to undertake. And that is also prudence, because you are clubbing risk, so you are not picking up odd risk or pricing it also in a way wherein you also kill yourselves. The second thing is, you specifically asked about how people are financial ratings, there's credit scores and all. I can tell you now products. I have a product which incentivizes people also for their financial health. If they have credit score, CIBIL score greater than 650, they are incentivized on premium on that. So, this is the customer centricity we are looking at. This is what we expect the consumers to value. They're just not looking at what do you pay in the hospital. The pizza topping cover approach is now there.
All of you wanted to add, right? Quickly.
So just one point. I think, all of them have, but just one point. If you look at, financial metrics, you'll find that I think our underwriting standards generally for the industry are pretty relaxed and they're pretty pro-customer. I mean, if you look at the combined ratio for the industry, I think it's significantly north of 100, which, so our frankly, underwriting, we are quite generous and relaxed about it as an industry.
Okay, one question, you got 4 answers. Quickly. Very brief, make it very brief.
I just wanted to know the impact of Bima Sugam on distribution companies and how it affects our distribution channels.
Okay, anybody? Just one person can take that. Yeah. Any other question from there? We'll take one more. Acha, we need to, okay, just get the, whoever is there, mic. That gentleman was raising hand for quite some time. Give pitch, whatever. I don't think, no, it's over. Let the answer come first.
Okay, so to my mind, I think Bima Sugam should not be looked as something which is interfering with distribution. I think what it is trying to do, to my mind, is it is trying to digitize things. It's trying to get everybody to a level playing field. It's trying to ensure that the entire journey, not only the policy issuance, but also the servicing and the claims gets digitized. I mean, just looking at it from a distribution perspective, perhaps becomes very, very narrow. What is also being attempted is that all channels, I mean, whether it's broking, whether all channels can also sort of operate through the Bima Sugam platform. So I don't think it is something which is a digital channel which is competing with the traditional channels. It is an enabler which is being created to bring all the companies on a level playing field.
Okay, thanks. Yeah, quickly, just very brief. We'll take, just quickly,
Sir, I look after the premium financing from early salary. We are already live with HDFC Ergo, and we are going live with
sure.
generally as well.
Yes, what is your question?
To know if insurers are looking at premium financing as a lever to increase penetration, or are we just looking at it as a payment option for the customers? Because we are ready to lend to customers that banks and credit cards are not ready for. But is insurers looking at us as a leverage, to leverage our proposition for the customer?
HDFC, you want to answer that? Very quick one-line answer.
See, at the end of the day, the regulator has identified 3 levers. I mean, Mr. Panda has spoken of awareness as one lever. He's spoken of accessibility as the second lever. He's spoken of affordability as the third lever. I think what you're talking of in a generic sense tries and sort of helps on the affordability side, wherein you're trying to break a larger premium payment into smaller. Anything which encourages that is most welcome. How it has to be done, the modus operandi, is really something which needs to evolve.
Okay, one more. Yeah, that gentleman was pitch. We will not be able to take so many questions quickly. This and one more here.
Hello. Yes. Sir, just one question. Basically, the regulator stance has changed. They are very helpful. But do you think for a sustainable, a lot of things are being opened up, but is the industry open to have that growth or have the systems and processes to handle that growth, so that there is no. And secondly, very bad experience of buying insurance online. I tried it, but it's very, very difficult. So
let's not get that specific thing. I mean, don't say which company, etc. You take it aside. You made your point. Bhargav, you want to answer?
The second one I'll still address. If it's been a poor experience with any one of us, please let us know. We'll be very happy to look at it, because selling online is obviously important for all of us. I don't know which company you experienced it with. It's something that we have to fix. Coming to your first question, the regulator opening up and creating an opportunity for us, why wouldn't the industry want to grow? I mean, every industry, every company wants to grow and become more successful. So there is no reason why any company won't want to grow. What could happen for some time is that there could be a lot of change, and everyone will have to figure out how to deal with the change and make a sustainable business plan and a operating strategy in that environment. So that could create some amount of instability for some time, but in the longer term, this is all very positive.
Okay. One second. This gentleman, if any of the insurers sitting here is the insurance company from whom you wanted to buy and got into trouble, when outside this arena, you can just give the feedback. Okay. Yes, please.
Good afternoon, everyone. So when we say insurance for all, one of the challenge which I foresee in the rural...
What's your question, please? No, not comment, because we are running short of time.
My question is, how do we plan to address the gap between the affordability and pricing?
Okay.
We see the insurance, and we saw a lot of policies by government, but when it comes to private life general insurance, we don't see, we see a more urban-oriented approach.
Okay. Affordability and pricing.
See, this is the classical struggle. Affordability and pricing is a matter of evolution. Like, for example, I'll give you an example, missing middle. Everybody wants to cover the missing middle. Niti Aayog did a research and they said these guys can pay between 4,000 to 6,000. Now, how do you really fit in a product? Maybe with certain features. Maybe, the Arogya Sanjeevani which comes in makes a start towards it. So it's going to be a journey, it's evolution. I think what we are conscious of also is the different segment of customers and their affordability. Or as the previous question said, no, there is a premium financing. We live in an EMI age. Why not we bring all these things and see that people get to experience and over a period of time customize.
Thanks. I know there are many more questions. I'm sorry we can't take, but you're welcome. If they have time, catch hold of them and ask them. But I'm picking up from this gentleman's question is, going beyond affordability and etc. Just taking insurance from India to Bharat. I mean, IRDA is talking about, is saying the slogan is insurance for all. It's also talking about, if I'm not mistaken, adaptation of villages by insurers, the dedicated distributions, etc. It's probably you guys can adopt villages or states, and also it's to some extent on the line how the banks negotiate with the local, very localized issues through SLBC, state level companies, like IRDA want also the insurers to do it. So how do you plan to do it? Can one of you or two of you say? Is it like the banks have their BC channel and they don't necessarily have to open their branches, but they can penetrate, and they have been penetrating, and there is last mile connectors also, the alliances with NBFCs and others. When it comes to insurance and taking insurance to villages, how do you make insurance for all? Technology, as I said, it's not your monopoly, it's not your USP. Everybody has technology. What else can you do? Bhargav, you are itching to answer, and then one more person can also talk about it.
I think the thought process, again, this is work in process. There's a lot of work that is going on.
Are you going for adoption of any particular village or what?
Coming to that. So one of the things that the regulator has already done is asked each company, or rather allocated each company a certain state, one or two states, depending on the size of your of the business. So most states would have one life company, one GI company, maybe a health company. And the expectation from the insurance company is to increase penetration into the micro markets in those states. Now, the approach there is being finalized, debated, very similar to what you're talking about, BCs and the dedicated insurance distribution channel or individual in every village. That's being talked about. The product construct is being finalized to make it appropriate for the rural customer. My sense is it's a matter of maybe a few months where we will see the clarity on the scheme. But there is a lot of effort that the regulator and the industry is doing together as we speak to address this gap that you're talking about.
Rakesh, Ritesh, Anup, anybody wants to add? Yes, both of you, quickly.
Go ahead.
Yeah. Anup, first,
so something very, very similar to what you said in terms of the banks is exactly what is happening here. Because the concept that Bhargav spoke of was essentially sort of saying that you will have a lead insurer. Non-life company, a life company.
SLBC concept.
Yeah, but sort of would be the lead insurer, and they will basically help drive the penetration. All the other companies will follow suit. So that is one. The other thing obviously which is there is that across the 269,000 panchayats, this whole concept of what is being spoken of as a Bima Vahak is something which is developing, wherein every sort of village panchayat must have, somebody who's selling insurance. Again, the concept is that the lead sort of insurer in a state actually goes out. For instance, HDFC Ergo has Tamil Nadu and Pondicherry. So then on the non-life side, we are supposed to take the lead. And in terms of trying to reach across and appoint all the Bima Vahaks, there is a very, very elaborate program which is there. Talking in terms of the fact that 42.5% must be done by the non-life company, another 42.5% by the life company, and 15% by the size. So a lot of thought is going on. It is work in progress. We should sort of see some of this coming out over the next couple of months. On the digital side, any which ways, there is a channel called the CSC. The e-governance platform.
Yes.
And probably that's also something which would come on its own. Because as we speak, there are almost about 300,000 sort of CSCs which are there across the country.
Anup, you wanted to add. You are a financially literate audience, but those who do not know, the SLBC stand for State Level Bankers Committee. So every state, one particular bank takes the leadership, and all the other banks join them, and that's how they get into all the MSME, SME financing, priority sector financing, so on and so forth. For instance, in West Bengal, probably UCO probably chairing the SLBC because that's the local bank. So that's something insurance regulator is thinking to take insurance in rural India. Yeah, please, Anup.
So just a couple of short points. One is that companies and not just insurers, they tend to look at urban markets currently as more attractive. And the reason for that is obviously got to do with the fact that the size of rural markets ends up at a granular level being small, and the cost of doing business there, because of the fixed cost and all, is high. So a couple of things that we have done which I can share with you. We currently, for a company of our scale, we get over 5% of our business from rural markets. What is defined as rural? And this is through tie-up with rural banks, and we have virtual sales offices in multiple cities or in villages and talukas, wherein a person is with a laptop and issues policies. And ma'am, to your point, we have significantly, eased out the underwriting guidelines so that in those markets, we are able to underwrite business at a certain scale and volume.
So Anup, you have 5% of your total...
My retail business.
5%. So what about you, Ritesh? What in percentage term from rural India?
Our percentage
of the
would
retail
be more
business?
like about 17, 18, because we are a very large crop player. I mean, that itself adds. But
including
at a
crop,
larger
you'd be at
level,
about 30.
Including
crop, you'd be at about 30%.
30%.
So at a larger level, I mean, if we were to see a lot of the rural areas, or if I may say semi-urban areas, see incrementally a much higher growth rate than what we see in urban India. So this is our journey, and I think each one of us...
Rakesh, how much is your rural?
We'll be also about a third of our business will come from rural.
30% plus.
Yeah, 30%.
Bhagav?
Ours would be in the teens if we include the CSC business and the crop business. But I think the point that Ritesh is making in terms of the growth, one of the things that we are seeing is this virtual office model is probably scaling up for all of us. We have about 900 odd virtual offices where we have people with laptops in these micro markets. And that's the way to reduce the distribution cost. And I think as the business scales in these markets, the growth will pick up even faster for the industry.
Thanks. We are coming to the almost end. A few minutes will take. We'll start with you, Anup. Just one sentence each. Can each of you tell us something interesting you are working on, which will benefit us as customer, as a consumer, which you look for? Because all of you are talking about the consumer centricity and customer is the king. So, because I know every product that you do, it needs to have the IRDA approval, and then you launch it. It's of course it's far more easier now than what it was till a few years back. But can each of you talk to us one unique product that the consumer can expect from your stable?
So,
starting with you, yeah.
So, I mean, in case you were to, and since I just have a couple of sentences, in case you were to talk about unique products, we try and do it in two forms. One is in terms of creating a new category, which we try to do with, for example, with pet insurance. Others is existing products. Can we make them more interesting, more inclusive?
Pet insurance.
Pet insurance. So we've done very well. They're much better than we thought we would. And a lot of the business has come online directly from the customer.
And that pet includes cats and dogs?
So it's currently only dogs because, like other people pointed out, we didn't have as much experience. But we have used underwriting guidelines for pet based on experience of insuring cows in rural India, which I'm not sure is related, but that's what we had to do.
So,
because...
Okay. Yeah, welcome that, yeah. Okay.
How are you?
Okay, so after pet insurance, what's the new thing coming up?
Otherwise, in our health product, for example, and you know that we have included products for the QR community. So same-sex partners, live-in partners can now be covered under the definition of family, which is what we have done with the health product, for instance. The other things which you're working on, but it's not fair for me to talk about it right now.
Anything interesting that we should know?
I think from our side,
I'm giving you a platform to market your products.
So cyber is one big category. I mean, which for the last 8-9 years has existed on the corporate side. It is in a real infancy as far as retail is concerned. I mean, and that's one. And B, I think making products in a smaller sachets is the other one. I mean, all the other categories are there. But how do you go out and create things in a 30-50 rupee package so that more people can buy it?
Okay, the key product in my view of an insurance company is actually claim. So, from Reliance, you'll pretty soon hear a certain segments of the customers will actually get claims without survey. Now, this is where your customer profiling really comes in. This is where your, that promise, how you uphold it comes in. So I think this is going to be a good level change.
Can you just explain it a bit?
So today, like each and every claim which comes to an insurance company has to come with a lot of documents. You have to substantiate an accident or, falling ill and all these things.
Okay.
Now, post that, we still pay 99% of the claims. It's not that you reject them. How can you really pre-profile and say there is an automated approval for those claims?
Okay.
So, product, since the use and file happened, one shot we launched 14 products, but I don't want to talk about products.
Something unique.
Yeah,
as
so,
a
so because,
consumer.
products, all of us have many products, launched. You started this session talking about, what is the role of insurance? And we talked about the fact that insurance should be much more engaging. I think the journey that we've had, and I want to share that with you, in terms of our app, was completely focused on engagement. It's called I'll Take Care. And the entire focus there was not sales, it was engagement. And I'll give you a small example. So on that app, you can actually, do a face scan, and you will give you your oxygen saturation level, which became very important during the, pandemic. I personally used it when I had COVID. So just as an example. So similarly, there's a lot of reward points, a lot of, free teleconsultation services, a lot of advisory services that you get. You can scan your food and you can get your calorie count, etc. So there's a lot of work that we are doing there in terms of engaging customers beyond claims. The point that we started, at the beginning discussing. So that app is doing really well. Added about 3 million customers as we speak, and adding 300,000 a month.
Thanks. We have come to the end. Anup, just start with cat also. I'm sure many of us here who have cats at pits. So finally, I just want one slogan each of you. I know individual companies have your own slogan and all, but say mutual fund, the difference between you and our friends in the other room is this. They have come out with something through AMFI, which sells the industry. Mutual fund sahi hai. So if you need to do something, Bhargav, starting with you. Acha, what would be the slogan for that?
So we had launched sort of a campaign which was called Faide Ki Baat.
Faide Ki Baat.
Because see,
that's HDFC Argo or for the entire industry?
This is the industry initiative.
When you say we have, meaning what is the body does that?
The GI Council launched a campaign which was Faide Ki Baat, because that is, what we said was, see, it's a risk product that we sell. It's not an assured return or any of these. But we said, ये अकल की बात है. This is ये फायदे की बात है. अगर हम लोग insurance ले रहे हैं, because there is so much that gets covered. This is a very, very effective risk sort of mitigation tool.
Any cricketers doing it, or who is saying it? Because AMFI got all the cricketers. So who is selling your फायदे के बात कौन बोल रहे हैं?
नहीं, हमारे फायदे की बात common आदमी बोल रहा था.
You can try to get Messi or pay some money, and a few $1 million you can pay and get Messi right now. So he's a heartthrob for India. I think that will आपको फायदा होगा इससे.
So as Anup said, we as an industry lose a lot of money on underwriting. We need to increase premium a lot to pay for Messi. We don't want to do that.
Okay. So I got good things. 3:05 we started at 5:02. So 1 hour. Thanks all of you. I think you enjoyed. I don't need to summarize, but one line is this. All of them are aware how things are changing, and I think they are all loving it. They are all liking it, what the regulator is doing. And I said it's a Hyderabad-Delhi combination, pushing it forward, and everything is for widening the market, having deeper penetration, and everything for the customers, right? With that note, we end, and give them a big hand, please. Thank you. Thank you for being with us.
Thank you, everybody. We'll be back at 3:30 for the last session of the event. It's a fireside chat with Mr. Shankar Sharma, founder G Quants. Welcome back. We'll begin in about 2 or 3 minutes.
सेविंग अकाउंट खोल सकते हैं। साथ ही ऑनलाइन जीवन प्रमाण पत्र जमा करने की सुविधा भी उपलब्ध है। देश के विकास में सूक्ष्म लघु और मध्यम उद्यम
Ladies and gentlemen, Mr. Shankar Sharma is here. Could you... All right, yes, please. So we've reached the last of the sessions at this Power Pack 2-day Business Standard BFSI Insight Summit. And what we have now is a very interesting fireside chat with Mr. Shankar Sharma, founder Quants. And in a conversation with him will be Business Standard Editorial Director, Mr. Ashok K. Bhattacharya. Over to you.
Thank you, Vinu. Once again, Mr. Sharma, Shankar, and call me AKB, okay? Yeah. It's wonderful to have you. And, whenever we sort of want to get a differentiated and yet perceptive voice on the Indian markets, let me say it on record that we look for your comments.
Sir, coming from you, that's an honor and a privilege.
So once again, thank you for agreeing to be here. There is no fire, but we'll have a fireside chat. Let me, begin without any, ado. What, in brief, would you characterize the current state of the markets?
So, the current state of the markets can be simply looked at it in terms of a very long-term catch-up of the Indian equity markets with global markets. And let me explain this a bit. So, if you look at the period of 10 years from 2010, which when we were just emerging from the financial, the GFC, till all the way up till 2020 March. So I'll give you some broad numbers. So January of 2008, the Sensex was 21,000. And just prior to COVID, the Sensex, which was in 2020, say February end, the Sensex was 37,000. So that's a gain of 16,000 points, or roughly whatever, 50% or 60% over a period of nearly 13 years.
That's right.
That annualized to something like 4 or 5% CAGR per year. Any self-respecting fixed deposit, even if the risk of going bust, you would still give it to PNC Bank and probably make more money.
That's right.
Okay, having invested in the Indian equity markets. And by the way, this return was in rupee terms. If you looked at the dollar returns, it was actually slightly negative in that entire period. And ultimately, the world is still a dollarized world, and we look at equity market returns in dollar terms to equalize things across all currencies and all countries. So if you look at it on that basis, India delivered precisely zero in dollar terms for nearly, I would think, 12 or 13 years prior to COVID. So the equity returns since COVID have been fabulous. We know that, right? If you eliminate just that spike, from 35,000, we are now at 62,000 or 60,000 of Sensex, which is fabulous returns by any standards. But it is nothing but a correction of a 10-12 year period of very, very low, in fact, abysmal returns. So we must understand this, AKB. Markets are cyclical.
So first point you're making is it's a correction. What is
happening? It's a cyclical catch-up.
Yeah.
In equity market returns. Because markets are cyclical by nature. This is one inherent, inescapable fact. We romanticize the good part and we ignore the bad part. But ultimately, we are going to get both parts.
Oh, that's a warning.
Always. It's a given. So Japanese markets can be the worst market, but it will have 2 or 3 fantastic years in a 10-year period when it will beat the daylights out of any market. So will a Argentinian market, or so will be a Zimbabwe market.
Yeah.
Every market has its day. We are having our day. That is underpinned by obviously our having done much better than the rest of the world in a very problematic last, let's say, 12 months.
Okay.
But as we were discussing just prior to this, India does well in global economic crisis. And there is a different reason for that, and that is because of the 91 crisis taught us a lot of things on how to make a national, at least a foreign exchange part of a balance sheet, very bulletproof. So we usually do well in global macro meltdowns. 2000 meltdown.com, we were not that affected. 2008, we were affected, but not as badly. And again, 2020 till 22, which is in variety of forms problematic, we have still done relatively better. So we actually love, global crisis as Indians. Yes,
that's right. So how would you characterize the market now?
No, I think India has, the building blocks of India's current situations were laid in 91, again coming out of a crisis. Crisis taught us a lot of things. At every successive level of government, irrespective of who has been there,
sure.
The leaders have been very focused on not shaking up the foundation of that knowledge or that crisis knowledge. We have kept building upon it. This government is building upon the previous government's knowledge base. The previous government built upon the previous government's knowledge base, and so on. I think overall, it is hard to find a country which is ticking all the boxes as India is right now.
Well, that's a big vote of confidence in the markets.
I'll break it up for you, AKB.
Sure.
Look at the world. Let's start from the Far East, Japan.
Yeah.
Anybody sensible wanting to invest there?
Sure.
No way. Let's move closer. You have China, then you have the Pacific Rim.
Yeah.
Taiwan has had its ups and downs, but it's because it's such a tech-centric and foundry-centric country, it will have its global cyclicality based on the semiconductor market, but a very single industry market. So, and it's a small market at the end of the day. China, again, vast unknown problems. Yeah. The known problems are bad enough. The unknown problems we have no idea about. And then you move to South Asia. India is the only game in town. Move again to the rest of the world from here, going west. How many countries do you... Europe, I think, is frankly no future except to become a giant tourist destination for Indians and Chinese. I don't see what else they have.
You are right, yeah.
I have a very good German friend in Dubai who's an investor in our funds. And he tells me that Germany, which is the best one of the lot, 1 out of 5 jobs is auto.
Yeah.
And most of those auto jobs won't have any meaningful existence 20 years from now. Okay, the rest is basically in various forms of industrial engineering, again, which they are not keeping pace with tech. So he was saying, I don't see what's the future for Germany. Now, if Germany doesn't have a future, I mean, why even talk about France and the other countries?
What about the US?
Yeah, so the interesting thing is if you look at equity market returns, AKB, over a 30-year period, the first market, the number one market, heads and shoulders above everybody else, has been the US.
Okay, in a 30-year time frame.
In a 30-year time frame, okay? But which is the number two market?
Don't test my knowledge.
India.
India, okay.
That's, everybody knows this, the first one, but very few people know the second one.
Okay.
India.
Okay.
And that is what I'm coming to, that...
Even in dollar terms?
Even in dollar terms.
Okay.
Even, I'm talking dollar terms.
Yeah, yeah.
So if you now come to further west, you have the US, and then you go down to Latin America. Again, very volatile life, volatile existence. So think about it. What are the options in this world today for equity risk that you want to take? US clearly, no matter what the problem is, has a huge plethora of choices in terms of sectors and companies and the tech edge that they have. But after that, we have just India, and that's it.
So how would you, let's say, I mean, you gave a fantastic, global worldview on the state of the Indian market, but would you like to or care to examine the pluses and minuses between India and China?
Yeah, sure.
Yeah.
So on the plus side, of course, we have plenty of pluses. And one of the, in my view, one of the biggest pluses is that on a global basis, we are the good boys of the world.
You still have the soft power, you say?
We are a good boy, whereas we are a soft power. People still like us. People may do business with the Chinese, but I can tell you, I live in Dubai. I meet a lot of businessmen from across the world. They don't like doing business with the Chinese for a variety of reasons. I hope there are no Chinese here.
No, I mean, there's no harm in telling the truth.
But the fact of the matter is that people trust India and Indians a lot more than they trust China and Chinese.
Okay.
And that is a big factor in the post-COVID world when people have lost whatever residual trust they had in China. And the general dislike I find, I went to Europe, I travel to Europe very often amongst European businessmen for China, is almost pathological, that they don't want to have anything to do with China. It's almost like that. So taking out supply chains will take time. But I think our plus is that we've generally been a well-behaved model student in the world economic landscape. And we will get our rewards for being that nice guy. We don't do cyber attacks. We don't encroach on other people's territories. We don't do all the hanky-panky that some of our neighbors do.
These are the good boy qualities.
This is the good boy qualities. It may make you look a loser for some time. It happens. But I think usually good boys will finish first. Okay. And I think this is our chance to finish first rather than finish last, as we have done in the past. That apart, I think there is a genuine shift of businesses from China to not just India, but there are neighboring countries as well. And in this world, I think Vietnam, for all its goodness, cannot absorb the kind of capacities in terms of manpower.
I was coming to that actually. Vietnam, I was coming to that. But you were saying that the capacity doesn't exist there.
Cannot go to that level, just the sheer size and the availability of labor. I mean, India can, at least on paper, have a lot of labor, a lot of land, right?
Yes.
No other country offers itself, as, with those advantages.
Yeah.
And of course, the debit side is there, that usually we've been slower to move off the blocks. I mean, we're a democracy. We will take, slower to make some certain decisions. This government has been good on that. So I don't think there are too many minuses. I mean, one of the key things, and I wrote an article in Business Standard, by the way, 2012, when we compared the national balance sheets of India and China, and we looked at all the hidden debt
Chinese have.
Okay, that the Chinese have, and it was a controversial article back then, because now it's consensus that they have 250% or 300% of GDP, debt as GDP, debt to GDP ratios. But back then it wasn't so. It was almost that they have grown without debt, and then we dissected the debt at every level and came to a number of 250% back then. And we said that we are going to look worse today in comparison because people don't look at the debt component underpinning the growth. But eventually that debt will come home to roost. And a lot of those problems that China has today, 10 years on, is because of the accumulation of debt to fund their growth. So you have a real estate bust, which is threatening large parts of the, the mortgage market. Or you have corporate level debt, you have provincial level debt, you have state level debt. India, fortunately, is still a manageable debt levels at all levels.
So, from a geopolitical point of view, also, you don't see the Indian market story getting impacted. And when I say geopolitical, I not only refer to the Ukraine-Russia crisis, but also to what is happening on our borders on our western side.
So Russia-Ukraine crisis is in the price. In my view, incrementally, I don't think there is much damage from a stock market perspective that you can see. That said, there is still damage to businesses in India. I talked to a lot of companies. European demand has been affected. We know that. I think it will take a while to come back. That's a fact. But whatever is there. I mean, it's already to a large extent factored in by markets, by companies and everybody. What is happening near to our borders, I don't think the stock market per se gets affected by that. Because I don't believe that it will escalate into something which is very major. Skirmishes, if you want to call them that, the stock markets, I'm not saying it's a good thing, but the stock markets don't care about a few losses of lives at the borders.
Sure.
Doesn't sound good, but that's the way markets are.
That's the way markets are. Yeah, that's right. Yeah. You set the scene very well. Now let me go to the next stage. How do you see the Indian markets in the next 2 years or 3 years or maybe 5 years, if it is not too long into the future?
So my view is very, very clear, unequivocal, that I think India is going to be easily the best and the top 2 performing markets in the world in the next.
Well, that's not saying much, because they have already been, by your numbers, you said that you're saying India
only last 1 year, but prior to that we had a lost decade.
A lost decade.
So to be clear, it was not always the case.
Sure.
I think that cyclical trend is over, and now the new cycle has begun in the last 12 months' time. I think, and by the way, it's important to understand that cycles of this kind are durable.
Okay.
Either way, in a bad way or in a good way. So if you go into a bear market on a relative basis, it will take a while for large economies to come back. Like India is still a very large economy by any standards. But when it turns and it goes up into an up cycle, that also is like a super tanker. You cannot just turn them around and make them bad.
So are we in that kind of a
We are in that positive side of the super tanker's journey now.
And how long will that period be?
It's going to be long. I mean, again, give you some context, the longer the preceding bad period is, the succeeding good period is usually at least 50% of that period. Okay. You've had a 10-year period of wilderness.
Okay.
I would easily think a 5-year period of reasonably good times. There will be bumps and ups and downs and all that. Ignore that. I think at least a 5-year period looks very good.
When did that clock start ticking for 5 years?
When COVID happened.
So that's in 2020.
That was the seminal moment.
Okay.
That's when our next good period started.
Okay, okay.
We made a break from the previous 10 years.
Okay, okay.
Or even 12 years.
So you don't think this will last till the Amrit Kaal, as they say?
I mean, if you happen to call me at that time, maybe we'll again revisit it. But, I mean, suffice it to say, I think we are in a very, very good wicket.
Sorry.
I mean, I hope we don't have any moves from a policy angle that make us get out on a hit wicket.
Okay, okay.
Because I think the pitch for India is reasonably flat. I think the ball for India is reasonably old. The sun for India is reasonably out.
Okay.
The bowlers are not bowling too well. I think only we can get ourselves out. I don't think the bowlers have it in them to get us out.
So what could be those, since you are using a cricket terminology, what could be those instances where we might get out hit wicket? Couple of instances, couple of problem areas.
We had a few in the past. I don't want to dwell on them.
Sure.
But, I mean, we don't want, again, I always say this, in a country like India, the leadership, like fund managers, we have alpha, right? That means
yes.
There is a market return and then you beat, and that is your alpha over the market, right? So what should be a government's alpha? That's the real question.
Yeah.
If you are a leader of a country like India, 120, 150 crore people, young population growth is 1.2% a year.
That's right.
Is 6%, 5%
is
I
par
mean,
for
in
the
my
course.
view, it's par for the course.
Absolutely.
इतना तो यार 150 करोड़ आदमी सुबह से उठता है, वो खाना खाता है, पीता है, पेट्रोल डालता है, घर जाता है, ऑफिस जाता है, कुछ उतना तो ऐसे ही 4-5% ग्रोथ आएगा.
Correct.
Right? Your alpha should begin after 7%, in my view.
Sure.
Till then, your market return in terms of growth. That's my view of looking at, my way of looking at it. Now, we will grow maybe 6% next year, as far as most consensus goes. My view is also similar to that.
Okay.
That
When
to
you say
my
next year, next financial year.
next financial year, correct?
Okay.
23-24.
Yeah.
So, my view is that is not earth-shatteringly good. It's not terrible in context of the world, but it's not something that I will give a lot of marks to any government, because 6% for a country like India is barely there, right? So, the things that can not derail it is what we need to worry about. We should be worried about. And to my mind, any big bang policy measures are to be avoided.
Okay.
We don't need brain waves. We don't need brain waves for India. We just need to be a broad guide of this super tanker.
Okay.
We don't want adventurism here in any policies. I think as Indians, as India, I think we are smart enough to figure out ways to grow.
Okay. Okay.
We shouldn't have brain waves.
And I mean, what can expedite that growth?
So the interesting thing is, India has been a conservative country by way of its economic management.
Yeah.
When I say conservative, it means the broad measures are internal debt to GDP and external debt to GDP.
Absolutely.
Broadly, those two measures show the degree of conservatism you have as an economy.
Absolutely.
On both these fronts, India has been traditionally very conservative after the 91 crisis. So our foreign debt to GDP must be about 20%. I mean, it's almost...
Yeah.
Right, internal debt to GDP was fairly low. It has now climbed because of obviously the crisis we have seen. But still, context-wise, it is not too bad. Now, the way to grow is ultimately you need resources. How else do you fund growth?
Sure.
Right? The resources will come out of debt because you have cut corporate tax levels. So that thing to come back to even parity levels is a while down the road, right? So in the interim, it can be your debt which fuels that growth, which is a problematic thing because debt, once it expands beyond a point, hard to rein back. Then you can only inflate it away. You can't really reduce it. Nobody repays debt.
Absolutely.
You just through increase nominal GDP growth, which
that only can help you.
That only can help you. Otherwise, there's no way on earth anybody can cut back on debt to GDP, right?
Sure.
So it's a tricky thing for the government. I know this government is very aggressive on deficits. Unlike the previous government, this government has been almost in your face in saying that we don't care about 4.5% or 5.5%. What are these? These are just numbers.
Yeah.
For a while, that can be fine. But it can be problematic, a little bit down the road. So the levers for growth for India ultimately are exports, to my mind, are not going to be a lever for growth.
You don't think so?
Your two biggest markets are Europe and US.
And that they are not.
They are, I mean, you don't export to any of our neighboring countries or in Asia.
That's right.
Two biggest trading blocks you have are Europe and US. They are in
out of
strife.
RCEP.
I mean, how on earth are you going to grow your exports? And if your net exports don't grow, then you have an impact on GDP growth straight away. I mean,
right,
arithmetically you're there, right?
Yeah.
You only had the domestic demand part of it. In my view, and which is what the real thing you should think about, or we all should think about, is whether the RBI is right in raising rates or not.
So you think that a time for a pause has come?
First of all, I don't think they should have raised in the first place.
Oh.
Yes. That is my view.
Well, how would you have bottled the inflation genie?
See, inflation is all rubbish anyway.
Okay.
What is inflation? Inflation is rate of change.
Okay. Yeah, absolutely. Yeah.
Rate of change.
Rate of change in the price.
By simple passage of time, the rate of change will come down.
Okay.
It's only the base effect.
Okay.
If your mobile phone is costing $100, it goes to 120, we say 20% inflation, correct?
That's right.
If it goes to 125, but the previous base has gone to 110. So now optically, it's whatever, 15 over 110, whatever 10, 12, 12%.
Yeah, I understand.
You wait another period, it will become 8%. We'll say, अरे यार, कम कर दिया, देखो inflation control किया. But boss, वो 135 हो गया already. We are only saying the rate of change has decreased. It is not going to go back to $100, which was the price. Please understand this.
Yeah, sure.
Mobile phone is not going to go back to $100. It's all smoke and mirrors anyway.
Yeah, okay.
My point is, by raising rates, has anybody done this? I'm sure you can do this very easily at BS. What is the interest rate sensitivity of the inflation basket?
Yeah.
Which part of your basket responds?
Well, there is the core and the non-core, which is
What is non-core and what is core? Who defines this?
Well, the economists doesn't define it.
But I am always having this conversation. How do you define core?
Yeah, well, which is seasonally adjusted, not. Anyway, I think that's a long debate, really.
What I'm saying is a lot of the basket, as far as I have seen, is not rate sensitive.
I agree, yeah.
So you end up actually hurting growth without hurting inflation. This was the mistake Mr. Subbarao made in the UPA 2 era.
Yeah.
Nothing happened to inflation. By passage of time, it came down, and then oil prices crashed when the current government came. I'm not saying it crashed because of the current government, but it just crashed.
But politically, it is sensitive, no? Inflation.
I know, but you can't be doing things just because you have to do something. Somebody has to somewhere stand up and say, guys, what we are doing has no effect on the villain we are trying to kill, but we end up killing the hero, and the hero is growth. So I'll tell you why I'm saying this again. I've said this even in 2011-12, that you shoot the wrong guy, okay? You don't shoot the villain. Now, today also, we will shoot the wrong guy. When your home rates are now at whatever, 8.5%?
Yeah.
Right?
Well, if you look at the real rate, it is not so. It's still very, I think, is just about 2% or so.
8.5% is 8.5%.
Yeah, but real is still 2.
That is, but ultimately when I'm paying 8.5% as a home
I agree.
owner.
Cost is 8%, yeah.
Their outflow element to me is higher by 30% or so as compared to what it was maybe a year or 2 years back.
Sure.
It will have an immediate effect on that. Now, the important thing is real estate is ultimately one of the key determinants of growth.
That's right.
Because the multiplier it has across goods and services is amazing. Like you start with the cement and the TNT bars and the steel and the window paints, the glass, the labor, the contractor, the transporters, to the AC, to the ducting, to the security guard from UP who is finally going to let in all the bad guys and keep out the good guys.
Yeah.
So if by raising rates you end up hurting real estate growth, which I think it will have an effect. I have been talking this time itself to a lot of people. They tell me, sir, it is beginning to pinch these higher rates.
I understand, yeah.
What is that going to do? It's going to hurt your growth. But will that bring oil prices down?
Fair enough. Point taken. Do you think on the demand side we have done something wrong in the sense that there has been a lot of demand destruction and no effort has been made to revive demand? The MSME guys are still clamoring for more relief, and they are the ones who were sustaining a lot of demand. And is that an area of concern for you? You see that?
I think I don't necessarily agree the government has not done enough on demand stimulation.
Okay.
But ultimately, I mean, in my view is that you have limited bullets.
Okay.
And you have to fire them wisely.
Yeah.
Now, it can debate whether corporate tax cut was a wise bullet to fire or not.
But that was in 2019, so.
Yeah, but I mean, maybe that bullet, if you
But kept it
for some other areas, it would have been better. But those debates are endless.
Yeah.
But the reality is that I don't think the government has given the state of the deficits. Today, our twin deficits are in the double digits. Between 10 and 12%. That's a pretty high number by any standards. You don't have unlimited money to spray around.
Yeah.
The worst thing we can do is to start copying the United States of America in terms of fiscal profligacy, because they have their internal and external, everything is in dollars. Ours is not.
Okay.
So we can't copy a rich man's game and hope to survive on that.
That's right.
We have bullets which we can't just spray around.
That's right. It will just about, I think 6 weeks later, you will have this budget. What are your thoughts on the coming budget? What do you think it should avoid, and what do you think it should actually focus on?
I haven't thought about it a lot. I've already given it a rating which is 12 out of 10.
Wow. As a newspaper, we have stopped taking ratings,
But I will still give it if you happen to invite me. That's my right.
That's right. But still, on a serious note, what do you think the budget should avoid? Let's start with that.
I mean, as an equity investor, they should not tinker around or rather increase the LTCGs or whatever STCGs or anything.
So capital gains tax structure should remain untouched.
I think it is pretty, good. Don't tinker around with the time periods or the rates or anything, because these things have a nasty habit in India of creeping up.
That's right.
Everything keeps creeping up. Once they open the door to some taxation, it never, goes back.
Yeah.
I just hope they don't do that. The equity markets have been buoyant. Government needs good equity markets to do a lot of the things it needs to do. So they should be very rational in these things.
Okay.
Don't tinker around with the capital gain structures.
And on, you said that you have strong views on the fiscal consolidation, and you think that the government should return to its path of fiscal consolidation as adhered to earlier.
It should, but I don't think it will, because you are entering an election period.
Yeah.
I really doubt if the government is going to. And if we can see a 6% year coming up, so can the government.
Sure.
So in that kind of scenario, which is pretty clear that we will slow down next year. I mean, that I think is almost a given. Given a variety of factors like the crisis in Ukraine as well as local macro challenges. I don't think the government will rein back on the balance sheet expansion. I think it will expand. Whether we agree, disagree, that's a different discussion.
Yeah. It has been such a engaging discussion that I realized that we have crossed half an hour, and that was our time.
Okay.
I cannot let you go if I don't ask you this question. Your views on Indian politics, if you wish to care. If you want to avoid that question, please avoid. But it will be good to know your views on politics as such. Let me put it this way: what role does politics play in the markets?
So I think politics in India, in a developing country, I mean, it has a very central role to stock markets. I mean, you can't ignore it. That said, I must only point out one interesting fact, and which is the United Front government, the much derided United Front government, of the second half of the 90s, delivered 8.5% GDP growth for the 2 years it was in power.
Yeah.
And we had a fantastic equity market period in that, 97, 98. Even the 99 period.
Yeah.
So, you can take your pick on what my view is. My view is, in a growth economy like India, as long as politicians behave responsibly, and we have been lucky to have had a series of good leaders in India, including the current one. I think on the leadership front, India has always had good leaders who are responsible in every sense of the word. And I think the tradition just continues.
Will it be correct to say that when all boats are rising, leaders do well, but when all boats are not rising, leaders don't do well?
That is possible, but the true test of a captain is when the boat is sinking. Does he jump off or does he try to save the ship?
I think time will tell.
Time will tell.
Just three quick questions and quick answers.
Sure, sir.
What keeps you happy?
Good health.
Good health. And what keeps you worried?
Loss of wealth.
Loss of wealth. And what makes you satisfied?
When I play with my daughter.
Fantastic. Thank you very much, Shankar. Thank you very much for this candid, forthright, straight from the heart answers. And we are really deeply grateful.
Thank you. Thank you for having me, AKB. Real pleasure and privilege. Thank you, sir.
Thank you. Thank you very much. Thank you.
Thank you very much, Mr. Sharma, and thank you, AKB. That was a very, very interesting, conversation, fireside chat. With that, we've come to the close of our, 2-day Business Standard BFSI Insights Summit. Thank you very much, everybody, for sparing time, and we hope that there were takeaways for everybody. Thank you, and have a great day. Thank you.